I just spent the last 2 months teaching my friend Josh how to become a consistently profitable trader in the stock market. And I documented the entire journey so now you can learn beside Josh step by step from A to Z as I take him from knowing absolutely nothing about trading to having then been equipped, having the skills, the knowledge, the resources to find that consistency and profitability within the market. This is absolutely for free, 4 hours of content on me, everything that you need to know. And with that said, let's begin.
Instant deposit available. We got it.
$500.
I'm already up.
All right, so you got filled. Stay tuned until the end to see if Josh loses all of his $500.
This is gonna...
Josh, it's good to have you back on the channel. It's been a while. You want to tell our viewers your past involvement with the Daily Traders?
Yeah, so I used to film every week consistently. I was part of the team for what, like a year and a half?
Yeah. You started out like filming these weekly YouTube videos with me.
Yeah, I filmed the first video. Mark flew me out to California and kind of just started from there. He's grown the company so much. It's insane. I left about a year ago. I moved down to Florida. And then
now I'm here.
Mark happened to move down to Florida as well. So now there's a reunion. And
now we're back.
This series is hopefully going to teach me how to trade.
That's the goal.
Become profitable. Not gamble on every contract.
Well, we filmed the video last year, like just one episode teaching you how to trade, but
yeah,
it's kind of all over the place. You didn't learn much, or you didn't retain much.
I didn't retain much.
So the idea here is to take Josh from literally knowing nothing to then becoming a consistently profitable trader. Listen, it could take 6 months, it could take a year, but we're gonna post an episode every Friday on this channel. And so if you're out there and you're looking to learn how to trade, well, you can come learn each week with Josh.
If I can do it, then you guys can definitely do it. I know
100%.
Nothing about the stock market. So this is a good time to hop on, follow the channel, grow with me.
It's awesome. I love it.
It'll be great.
So I want to just kind of premise this by saying, I think there's a very specific way we can go about teaching you, which is also the way I go about trading that will pair well with your current lifestyle.
I work 5 days a week, 9 to 5. I have some time in the morning.
So let me ask you roughly, how much time per day would you say you have to trade?
Only about an hour, not much.
Okay, so about an hour a day. Roughly how much capital would you start out with investing?
Probably around $1,000. I don't want to
Okay.
put too much up front, lose a bunch of money, but.
Okay, around 1,000. Well, that's good. That's a great place to start. Now, I would say there's kind of two options when it comes to anyone looking to get started trading. And you can kind of choose the route of day trading or the route of swing trading. Do you know what a swing trade is and what a day trade is?
So I did retain this from the last video.
Glad to hear.
A day trade is when you open and close a position the same day.
Yep.
A swing trade is when you open a position and close it a different day.
Yes. So I would say, because it does require a lot of time day trading, you're actively going to have to be monitoring your positions. You know, it might require 3, 4, 5 hours of your time a day sitting on the market. Most strategies that correlate to day trading are going to take most of your time, or at least so much time that it wouldn't allow you to have that flexibility with your job and your current life to actually make money trading, is what I believe. So by learning swing trading and the way I trade, which is through swing trading, with an hour a day, that is as much time as you're gonna need for the strategy that we're gonna eventually get to, that I'm gonna eventually teach you. So that's totally fine. And then when it comes to the capital that you're looking to start out trading with, what I trade are called options. You know what an option is?
I do know what an option is.
You wanna try to explain to the audience just briefly?
An option is when you leverage your money. So it's 100 to 1,
Yep.
correct?
Yep.
And then you're essentially betting on the stock or the market either going up or down. A call is when you want the market to go up, and a put is when you want the market to go down.
That's awesome. Yeah, so options, you buy what is called an option contract, betting on a stock to either go up or down. So, yep, calls, you're betting on the stock to go up, puts, you're betting on the stock to go down. And now options are leveraged 100 to 1, right? Because one share of, say, Microsoft, let's say Microsoft's trading at $200 for a share, one option contract is going to essentially buy you 100 shares. So what this is going to allow is for you with $1,000, somewhere around that amount, to actually be able to see some worthwhile gains through trading. Think about it like this. If you, let's say a stock's trading at $1,000 and you buy one share, because that's all you can afford, and you can only bet on the direction of that stock to go up. So let's say that stock goes up 1%. Well, how much money do you just make?
$10.
Right? Okay, now whereas if you bought one option contract for $1,000, let's just say theoretically that stock goes up 1%. Now there's a lot of variables that go into options specifically to figure out exactly how much that contract would gain in value. But you could just imagine that you just went from owning one share, which was equivalent to $1,000, to now owning 100 shares.
Which is $100,000.
$100,000.
So good money.
Leverage. I hope that makes sense.
It does.
Is that an okay explanation?
I get that.
Cool. That is the direction I think we should take you. So swing trading, options.
Agree.
And just inherently know that there is more risk that comes with options. We're going to literally go step by step through this entire process, week by week, from the very basic beginning point, which is what we're going to do today. The plan is to hop on inside my computer. Step one is to find a broker that is going to allow us to trade options. And we're actually going to have to get you approved to trade options, whatever level that would be. So we're going to go over all the options and just make sure that you have the brokerage that you can go ahead and put your money in to then be able to trade the right vehicle, in this case being options. So let's hop on inside my computer. Josh and I just want to take a quick second before we start to mention the fact that this is like a rare opportunity for Josh to have someone that he knows personally to coach him and mentor him and help him become a consistently profitable trader. That's the goal.
Very fortunate to have such a great mentor like Mark. He'll sit down, work with me. Fortunately for you guys, he can also be your mentor.
Yeah, and this is something that I've been doing. I've been coaching students now for 2.5 years. One of the things that I actually allow my students to do is have the ability to kind of look over my shoulder and see the exact trades, the exact positions that I'm taking in the stock market. So whenever I go and put on a trade, I go ahead and I post that position to my group. Hey, I'm buying these option contracts on this stock. This is why I'm taking this position, right? Whether I'm betting on that stock to go up or down. And I explain my actual trade plan, trade idea. And then it is up to the individual whether they want to hop in and essentially copy that exact same position that I just put on. And then obviously when I go to close that trade, I will post that exit. And whether I'm making money or losing money, I'm 100% transparent. So it's pretty cool.
It's pretty awesome.
And then along with that, I actually did put together a curriculum covering my entire trading system and strategy, essentially everything I've learned over the last almost 7 years. There's a lot more that also is included. That is over inside my mentorship group. So I will put a link in the description below. It will be the first link. You can head over to my website, see everything that is included. And if you would like to go ahead and apply, you are more than welcome to do so. But with that said, let's hop on inside my computer and let's create this trading account.
Let's do it.
So what we're gonna have to do is go to Charles Schwab, open up the right account and get approved for options trading because you need the flexibility to trade options. And then we'll actually dive into what is called a paper account. We'll talk about what that is and we'll open a paper account. We're not sponsored or endorsed by Thinkorswim or Schwab. There are plenty of other options out there, plenty of brokerages available. I know that Thinkorswim does offer what is called a paper account, which is essentially just simulated virtual money. So it's a way to go about trading without putting or risking any real capital on the line. And I think that is the direction we should take, you being a beginner. And you're gonna have to go through and learn a bunch of these very beginner things where it's just not worth risking your actual money. And so plenty of traders spend months and months just trading with simulated fake money, becoming consistently profitable that way before they ever even transition into a live market. And obviously there's like a degree of emotion that comes along when you go to trade on a real live market. That is something you're gonna have to eventually learn how to deal with that emotion. But right now we wanna open up this account, get approved for options, and then create this paper login, however they go about offering that. So we'll figure that out. If you guys want to find another broker, that is fine. And also if you're under 18, I know that Charles Schwab does offer a custodial account. So a custodial account essentially just allows your parents to create an account for you and then you can trade on that account under their name, essentially. So let's go to Charles Schwab. So open an account. So we have a couple options here. Let's see. We're going to want to open an individual brokerage account. And then the joint brokerage account would be if you're under 18. Again, this is what it's gonna look like for everyone. So again, step one into getting started is opening up a brokerage account. All right, we're gonna go through and fill this out and we'll just blur everything. So now a quick note, if you are outside of the US, there are brokerages available that do let you trade the US stock market and buy and sell options. I will put a list in the video description below. Yes, you will have to go and watch a tutorial on how to set up that broker, but the rest of the series will apply to you essentially. So don't worry, you can still follow along week by week as we go. Okay, here we go.
Oh,
Awesome. Why are you opening this account?
general purposes.
Yep. Wait, hang on, let's see. Okay, yeah, general purposes is fine. What are the sources of funds for your brokerage account? Select all that apply. Now this doesn't really matter. All right, it's asking for your employment status. That will all be blurred out. So no and no.
Continue.
Yep. Okay, this is what is very important, so pay attention. So would you like to add these trading features? Essentially, there's three options here. We've got margin, we've got options trading, and then scroll down a bit, Thinkorswim trading platform. We do not want a margin account. We're gonna talk about this, but we want what is called a cash account because there is what is called the PDT rule. That is the pattern day trading rule. Have you heard about that?
Briefly.
Essentially, what that means is that unless you have over $25,000, you can only place 3 trades within a 5-day period. That is with a margin account. If you have more than 25,000, that means you're above PDT. You can buy and sell as many times as you'd like within the same day. I forgot to clarify, within the same day. So 3 trades within the same day, within 5 trading days. If you bought a stock, sold it, that's 1 today. And then tomorrow, if you bought a stock, sold it, that's 1. Then you'd have to wait another 5 days from that first buy to then get that trade back, right? Anyway, we're gonna say no to a margin account because we're gonna want a cash account so we can avoid PDT. And then when it comes to options trading, that is the direction that we are going to go. So yes, we are going to add options trading as a feature. We are also going to enable Thinkorswim, okay? This is gonna be the platform that we're gonna be placing all of our trades on. Continue. So let's go with long. We don't need spreads. We don't need short uncovered. All right, so when it comes to the trading history, they might decline you because of your experience. So if you were trying to get that last option, which is essentially the riskiest, then you might not get approved when it comes to your knowledge level. But let's go through this. All right. Hey, let's go. You got approved.
Let's do it.
We are in, we're ready to roll. We've got your total account value sitting here in front of us. 4 cents, ready to roll. Now what we're going to do is essentially download Thinkorswim. We're gonna get that on your desktop so we can start trading on there, which is actually what is behind you on that screen, Thinkorswim. So that is my account actually. And we'll go ahead and get that set up for yourself. We'll make sure that you are on a cash account. And essentially what a cash account means is that you are no longer stuck having to deal with this PDT rule.
Don't need that 25 grand.
Don't need 25 grand. Say you have $1,000 in your account. Now, what this means is that when you place a trade with a cash account, you can only trade with settled cash. Now, it takes until the next business day for that money to settle. So for example, if you put on a position that costs $500 today, and then tomorrow you sell out of that position and you get $550 back. So say you made 50 bucks. Now your total account value is $1,050. You have to wait then until the next business day to be able to trade with that $550 you just made, or whatever if you just lost. So you'll only have 500 in buying power at that time on that given day, even though you sold. So essentially just that day when you get out of your position, you can't go back in and trade with that same capital. You have to wait overnight to be able to trade with it again.
Okay.
Does that make sense?
That makes sense.
The great thing is, because we're gonna go about swing trading, this does not matter. You do not have to worry about having a bunch of capital, either over 25K to have unlimited day trades in a margin account, or plenty of cash in your cash account to be able to trade, because you have to wait for that cash to settle, because we're only gonna be putting on couple positions a week. And because we're swing trading, we're going to be swinging that position overnight. So that cash is going to be settling. So when I even started out, I've never ran into an issue trading on a cash account. I've never seen my students run into an issue trading on a cash account because the cash settles overnight and it's just not a big deal. You don't have to deal with any of these restrictions with PDT. All right, so now that your account is created, the next step is to head over to Thinkorswim. Now we're going to download Thinkorswim desktop. We've already opened a account. Now this is weird because TD Ameritrade is currently moving all of its clients over to Charles Schwab. So we did go directly through Schwab to create this account. However, I think you can still create an account on Thinkorswim at the time being. You can also download the mobile app, but right now we're gonna be doing all of our work here for this series on the desktop app. So I already do have it downloaded, but if you have not downloaded it yet, you're just gonna hit the log in to download button right there. You can go ahead and log in at this point with that login ID and password you created over on Schwab. Okay, hit log into Thinkorswim. Which screen did it go on? Here, hang on. All right, so now we are ready to, well, essentially what we have to do now is make sure that you have a cash account and that you have the ability to trade with paper money. So that's good. It looks like your account was set up correctly. Obviously, there is no capital currently in your account. Okay, we didn't fund it with anything. And then we've got our platform. Now this is where we're gonna be doing all of our work for the coming months. Okay, so because we chose the option to not open a margin account through the application process in the beginning, well, now you can see here under account info, we have unsettled cash, cash and sweep vehicles, available funds for trading, obviously the option buying power, net liquidity, and day trades. So that means that we have a cash account. It's pretty straightforward. As long as you hit no to margin account, well, then you are immediately on a cash account. Now, in the next episode, we're gonna hop into the Thinkorswim platform that we're looking at now. We're gonna talk about how to go about setting up Thinkorswim, how I have it set up from, I guess, like a user functionality and customizability standpoint. What are we gonna look at? What tools do we wanna use? What are we gonna utilize on this platform for our trading? But right now, we're gonna hop on to the paper account. So funny enough, we're gonna have to cancel out of this and log in again, and I'll show you where it gives you the option to log in with the paper account.
Just click on it.
Yeah, just close out.
Logo.
All right, so back on the login screen, you can see we've got live trading and we've got paper money. So we wanna go to paper money and then essentially just log in again. So it's pretty straightforward. All right, so we are logging in, and we should see virtually the same platform. All right, so this looks virtually the same, except now you can see on the top left, simulated trading.
Mark put $200,000 in my account to learn how to trade.
200. So that's great. We've got 200,000 in option buying power, okay? Forex buying power, 10,000, net liquidity and day trades, 200,000, cash and sweep vehicles, 200K. So essentially they start you out with 200,000 in paper capital to begin trading with. Now, the thing about a paper account is actually it says connected and it says real-time data. So that's wonderful. This is something that Ameritrade used to not do. You had to have 2K in your account to get real time. Now up here where it says connected and where it says real-time data, this is important. We want this to be real time. If this says delayed data or delayed 20 minutes, that means that when the market opens at say 9:30 Eastern, it's gonna take another 20 minutes for your account to actually appear as though the market is open. So everything is gonna be delayed 20 minutes. You're all set automatically. We've got real-time data. It should work for everyone. If it does not say real-time data up here, then all you have to do is go to support and then create a support request. And all you have to say is, please enable real-time data. They'll enable it or they'll give you like very brief instructions on how to enable real-time data. But you need to make sure that you have real-time data enabled. Otherwise, you're stuck behind 20 minutes. Their support is super great, so you shouldn't have an issue. So just to recap, we headed over to Charles Schwab. We then opened up an account on Schwab. We chose the option to not open up a margin account. So therefore we opened up a cash account and we got approved for options level 2. And then we went over and we downloaded Thinkorswim desktop. And then on Thinkorswim desktop, we had the option to look at our live trading account or our paper account. And now we're sitting here looking at our paper account. So next week, what we're gonna do is hop into how to go about setting up your Thinkorswim platform. Does that sound good?
Sounds great.
Are you excited, Josh?
I'm excited. We're gonna learn step by step.
We're gonna make money.
I'm so excited.
We're gonna become a millionaire overnight.
It's gonna take me sub 30 minutes.
No, we're gonna take our time. We're gonna go step by step, and we're gonna take you guys along every single part of the process. So don't forget to subscribe if you want to learn how to become a consistently profitable trader with Josh every week on Friday at 3 p.m. Eastern Standard Time.
Smash that like button.
Smash that like button and drop a comment with what do people comment these days? And again, the first link in the description below is going to be to my mentorship group where you can apply to then have access to see and copy my exact trades in the stock market if you so desire. With that said, I'll see you all in the next, with that said, we'll see you all in the next YouTube video.
Peace.
Later. This is part 2 in the series where I'm going to be teaching my friend Josh how to become a consistently profitable trader in the stock market. Over the coming months, Josh will be learning my entire trading system. Essentially, everything that I've learned after trading for the past 7 years in various markets. Now, my goal is to not only help Josh learn how to trade, but to also help you. So if you've ever wanted to learn, now is the time. Tune in each week on Friday to follow along and become consistently profitable with Josh. All right, Josh, you ready to go?
Let's get it.
So today I'm going to be teaching you how to use and set up Thinkorswim, which is the platform that you'll be trading on moving forward in this series.
Sounds good.
Now, if you're outside of the US and you don't have access to Thinkorswim, I put a link in the description below to an alternative broker that will allow you to trade options, as well as a platform that you can sync with that broker for all the charting and technical analysis needs so you can follow along in this series. Just a heads up, the most effective way to learn with Josh is to go back and start on part 1, just so you don't miss anything. All right, let's hop on inside my computer. All right, so when you log on to Thinkorswim, this is the default layout that everyone is gonna be presented with. We're gonna just hop right in and we're gonna change a couple things right off the bat. We're gonna clean it up a bit. I think, simpler is always better, and we don't need to be looking at all of this stuff. It's kind of a headache. So we'll go over a bit of the functionality, or all the functionalities that we will be taking advantage of, that we will be needing for our trading for the purpose of this series, and then go about applying the settings and kind of customizing the dashboard as to how I like it myself. So if you have any questions, just let me know. First things first, we've got all these tabs on the top. Okay. So monitor, trade, analyze, scan, market watch, charts, tools, education, and help. These are really the only 3 tabs we'll be using right here. Monitor, trade, and analyze.
All right.
Okay. And then on the side here, we've got the account info. If I unhide this real quick, we'll have our editor blur your account number, but we can see your option buying power, net liquidity and day trades, all of the information, just giving you your balances as to your account, but you've got no capital in there right now. Okay, we've got, messages. We're gonna reach out to their support. Let's just start off by deleting these gadgets. So on the left here, this is where we'll have the ability to add our watch lists. So we don't need this live news. I'm gonna go ahead, delete that. Trader TV, delete that. One watch list, that's good. And then we'll delete this gadget. So we're gonna wanna set up 2 watch lists. So we're gonna click on this plus down here, and then we're gonna go to watch lists. And now we've got 2 watch lists. All right, now we're gonna change both watch lists to red and red. And then we're gonna change under trade and active trader, change this. We'll toggle to red. Okay, I'll explain why.
Okay.
Watch lists, we're gonna go to personal, okay? And then you've got kind of these default watch lists. You can look at any watch list. So for NASDAQ 100, S&P 500, you can pull up the corresponding watch list. So let's say like you want to go look at stocks in the NASDAQ 100. There you go. And then you've got the drop down, and then you can see those stocks. So we're going to go ahead and create 2 personal watch lists. Now, I used to have 4, but this is how I have it structured now. So all I'm going to have, if we go to create watch list 2023 watch list. This is the watch list where you're going to be adding the stocks that we're eventually going to get to, the point where we're having a list of 3, 4, 5 stocks that we're going to be looking at. So that's where we're going to put those stocks. And then you just click under the symbol, and then you can add a stock to your watch list like Apple, right?
Okay.
And then it's pretty easy, right? And then we'll create another watch list, right? Create watch list. This watch list is going to be open position. So anytime you actually have an active trade on, you'll add that ticker symbol right here. So let's say Apple. So yeah, it's pretty straightforward.
Okay.
So we've got the 2 watch lists, 2023 watch list, open positions. Now here on the active trader under, trade, all we have to do is go up to this little icon, or this, I don't even know what to call this. We go up to here and we're just going to want to look at one screen. You can have like as many screens as you want. So say you want to look at 20 charts at once, there you go. Okay. But we're just going to need to have one chart pulled up, and then you have these kind of toggles on the right here, active trader, big buttons, chart 2, chart 3. All I use is going to be, well, just the chart. Okay. So again, just one chart.
Keeping it simple.
None of these are going to be toggled on. All right. And so this is the default chart. Let's see if we go into, we'll kind of cover what is in each tab here, but let's just go about setting up your chart. So we'll go to setup. Just let me know if you have any questions, by the way, but we're just trying to run through this like relatively fast. So this is going to be the main chart. This is the main chart that we're going to use to do all of our technical analysis on. Okay. Now, when it comes to my trading, we talked about this in episode 1. I am a swing trader. That is what we're going to be focusing on with you because of your lifestyle, right? You said you have about an hour a day to trade, roughly.
Yeah.
And so with the trading system I have in place, it requires no more than 1 hour of your time each day, which is great. So when it comes to my trading and when it comes to time frames in trading, do you know what time frames are?
Yeah. So it's like the candlesticks, right? Each candlestick is, if you're on them 1 minute, it's over the course of a day, right? Then each candlestick is a minute.
Yeah. Okay. So each candle, these are candlesticks, right? Is going to represent a certain amount of time. So example, we are looking at the 1 minute right here. This is the 1 day, 1 minute. So if we zoom all the way out, what we can see here is 1 day. Okay. This is pre-market. This is aftermarket. Okay. And then the black is during market hours, during active market hours. Okay. We've got aftermarket, pre-market, active market hours. And this is where we're trading at right now. If we go to the 5 minute, each candle represents 5 minutes. If we go to the 4 hour, each candle represents 4 hours. Okay, so with day trading, the typical time frames that most traders are going to be doing their work on are going to be the 1 minute time frame, where each candle represents 1 minute of time, the 5 minute time frame, okay, where each candle represents 5 minutes of time, and the 15-minute time frame. That's typical for a day trading strategy, because when you're day trading, you're getting in a position on that current day, you're getting out on that current day. Swing trading, like we talked about in part 1, you're entering a trade today, and then say you're holding it overnight and closing it tomorrow, or many days later.
Okay.
So all of my work from a technical perspective, which is how I go about trading, is going to be done on the 4 hour time frame. So I'm always going to be looking on the 4 hour time frame.
You never look at a different time frame. It's always 4 hours.
Always 4 hour.
Okay.
Any of my trade decisions, when it comes to actually, at the end of the day, I don't want to get ahead here, but when it comes to actually putting on a trade, doing my analysis, figuring out what stocks to trade, what direction to bet on that stock going, everything is going to be done on the 4 hour time frame.
Okay.
Now that allows me to kind of slow everything down and then be able to put on positions where my average hold period is going to be between 3 to 5 days. So say I'm entering a trade today, I'm going to be holding that stock for the next 3 to 5 days. So we're going to go ahead and we're going to put our chart on the 4 hour time frame. And it's not just the 4 hour, it's going to be the 4 hour 180 day. So I'm looking back. If I zoom all the way out here, this is like how you zoom out. This is how you zoom in. Okay. I'm looking back at the last 180 days. And then what I'm going to want to do, because if you could see, we're currently stuck we're stuck here on the edge. You can't see what's happening in front. It just makes it hard to really look at a chart and break it down or do any analysis. So what I want to do is go to the little gear icon right here. We're going to go to, I believe it's time axis. Okay. So time axis, expansion area, bars to the right. We're going to type in 180. Now we're going to click apply and okay. Now we can see
180 days behind you, 180 days
180 bars.
Bars.
So yeah, it's not days. this doesn't matter. This is, you can make it 360. I just like 180. Like 360 is just going to give you a little more room, right? Just a little more space here. But I like 180. It seems like a good amount of space to have to work with. Again, just so we're not like kind of crunched in the edge of the screen there. So 180, okay, apply, okay. And then we go back to the gear icon. We'll run through kind of how I have my chart set up. Overlap volume, we're gonna want to uncheck. Okay, apply that and you can see what that looks like. We've got the volume there. We wanna get rid of this entirely. Let's see, so overlap volume, you can uncheck that. Price axis, time axis, good. Favorite time frames, good. Appearance, again, this is all kind of preference based. This is just how I have it set up though. We're gonna uncheck grid, okay? And then I like filling the candles. So we're gonna click on fill up and now you can see it's gonna fill in the green candles like that. Okay, so next we want to remove the volume. We're gonna go to equities and then uncheck show volume subgraph, apply that. Okay, so now we've got a pretty clean looking chart right here. Okay, we're on the 4-hour time frame looking back over the last 180 days.
So why do you only look back 180 days?
So when it comes to my trading and trading in general, I think the more simplified it can be when it comes to your process, okay, how you're going about making your decisions, the more systematic it can be, right? The more repeatable it can be, the more scalable it can be. The goal here, again, is to get you to the point where you're consistently profitable. To find consistency is finding repeatability. And so less variables essentially in the equation are going to help you have this system that is essentially at the end of the day going to be more repeatable for yourself. So there's less variables involved. So by only looking back at the last 180 days, that means the high, you see this, the high and the low. Well, there's only going to be one high and low, and that is going to stay consistent. So you're not going to be jumping from, a 4-hour and then looking at the last 365 days because that high and the low are going to be different. Or, looking on the 4-hour over the last 40 days because that high and the low are going to be different. Without getting too far ahead, I do a lot of my trading around highs and lows, but it's just the more systematic this can be, the more repeatable the system is going to be as a whole, your trading system.
Okay.
Or what I'm teaching you, right? You just had a really good point.
Yeah, it is a rare opportunity for somebody to have a mentor in their own personal life. Fortunately, I have Mark to mentor me over the next couple months.
One of the things I offer as a mentor and a coach online is the access and the ability to see, essentially look over my shoulder, right? And see the positions that I am putting on. So anytime I'm entering a trade in the stock market, I am calling that position out. And my students over inside my mentorship group are actually able to get in on that same position and, well, make or lose money, whatever the outcome is, whatever happens with the trade. So it's something that not many people offer out there. And I've been doing this for now 2 years. Not only coaching, mentoring, and helping people learn the lifelong skill of trading, but being fully transparent and giving people access to see and copy my exact trades if they so desire. So if you're interested in kind of fast tracking your progress in the market, if you don't want to take the 6 to 12 months to learn the lifelong skill of trading, you can go ahead and click the first link in the description below. Check out my website and see if it's something you'd be interested in. And if so, I highly encourage you to apply.
Makes sense.
So this is what my chart's going to look like. Now, if we go up to this little studies, you can add strategies, you can add different indicators. Now, I don't use any indicators to trade with. And this is like...
What's an indicator?
Great question. There are different indicators that are essentially going to give you an idea for when looking at a chart, say Apple on the 4-hour. If we add one of these indicators, like the CAM indicator, well, that is going to tell us something about price or price action or price movement. The indicator is going to help give you an indication of where the stock is going to go.
Okay.
What direction the stock is going to move. So one of the very basic beginner indicators that a lot of people use is going to be like the RSI. The RSI is going to give you an idea as to overbought and oversold. A lot of people go off the RSI without realizing that what is overbought can continue to become more overbought, and what is oversold can continue to become more oversold. So someone would treat the RSI as an indicator of, hey, we're in overbought territory, that means I should go short, or we're in oversold territory, that means I should go long. Whereas that's really not the case. I think I've seen, time and time again, Traders get into the market. They start with 10, 20 indicators, and slowly they remove all the indicators from their chart over time. So I don't use any indicators to trade with. Again, no fluff, keep it simple. What I do use to trade with are called moving averages, okay? We're gonna go about applying those moving averages to our chart. Do you know what a moving average is?
I can't define it. I know what they look like. I've seen them before, but I can't define it.
So a moving average is essentially the average price movement of that stock over a given time period.
That makes sense.
For example, there are 3 moving averages that I use in my trading. Now, if we go back to the studies, we're gonna add 3 moving averages. We're gonna type in simple, okay? Simple moving average. We're gonna go ahead and add that one.
The SMA.
SMA, simple moving average. Now we're gonna add another SMA. So we've got 2 SMAs.
Okay.
And then we're gonna add an exponential moving average. That's an EMA. So I think it's exponential, moving average exponential. Okay. And we're gonna add one of those. Now for the 2 SMAs, we're gonna go to this little gear icon, and then under length, we're gonna type in 50. And the color for this I use is red. Okay, so the 50-day simple moving average. Okay, now you can see like TOS's little description of a moving average, but this is going to be essentially the average price movement over the last 50 days. Why are moving averages important? What are they used for in my trading? We'll get to that. Right now, we just want to make sure our TOS is set up so we can start trading. And then the second simple moving average is going to be the 180-day SMA. So you're going to go under length, 180, color, and under color, I use green. Okay, great. Now, moving average exponential, the EMA is going to be 15. This is going to be the 15-day EMA, and that is going to be blue. Okay, hit OK, hit apply, hit OK. Now, if you are not on Thinkorswim, if you are on TradingView, which was my recommendation, or if you're on another platform, well, you're gonna have access to add an exponential moving average and a simple moving average. You'll be able to select the lengths, okay, of that moving average and the colors. So you should be able to do all of this and follow along, okay? Just make sure you have these 3 moving averages, the 180-day SMA, which is that green line right there, the 50-day SMA, which is that red line right there, and the 15-day EMA, which is that blue line right there. And you can see right here, okay, red is a 50-day SMA, green 180-day SMA, and blue 15-day EMA. So this is it. This is what we're going to be looking at.
Way simpler than what we started with.
Way simpler,
way easier to look at.
Way easier to look at, way cleaner. If you want to just buy shares of stock, you can click on trade, and then you can buy shares this way. You can click on the amount of shares you'd like to buy. Say it's 100, and then you just hit buy market, and you send that through, okay? Click on buy market, and then you can click send. Or you can use like the active trader. There's just a couple different views they give you, a couple options, for however you'd like to go about buying or selling your shares. But we're going to be trading options. We talked about why in episode 1. So are you following along?
I'm following along. This is pretty simple. It's just kind of me like looking and showing like where to click and that kind of stuff.
Okay.
Right? But like actually how to like buy an option on this and that kind of stuff, I don't know how to do.
Okay, let me show you how you actually go to what is called the options chain. So if you're under trade and you go to all products, well, here is the options chain. Now, we're not going to get into reading the options chain or actually buying option contracts yet. Okay, we're going to get to that eventually. But just know that under trade, all products, this is where we're going to go eventually to buy our option contracts. Okay. Now, just to recap, I trade options. That's what I'm going to teach Josh how to do. Options essentially give you the ability to leverage your money 100 to 1 because one option contract is equivalent to buying 100 shares of a stock. So that is why with less capital to trade, options is the way to go. Just knowing that there's inherently more risk, right? With more reward comes more risk. So we'll learn how to manage that risk. Don't be overwhelmed. We will cover to the full extent needed how options work, how to go about buying them. But right now, let's just get our TOS set up.
One step at a time.
So we've got activity and positions. Okay, if you have a trade on, this is where you're gonna see your active trade.
Okay.
There'll be like a little summary. It'll say the stock, the ticker, and your P&L. Account statement, this is where you're just gonna have access to see any trades you currently have on, look back at previous trades, your profit and losses.
So it'll show your trade history on here.
Show your trade history. So if we go 1 day back from today, you can look, say, 365 days back from today, and then just apply. So 365, we can see the last 365 trades you took.
Okay.
This is just going to be like your account balances, everything, your account summary, all of that. And then if we click this privacy, again, all that does is it allows you to see all of your account balances. And then we do have to blur your account. So eventually we'll get into the Analyze tab, how this works, the risk profile. Any questions so far? It's pretty straightforward. Yeah.
Pretty straightforward. So trade is where you look at the charts, and then you place whatever you want to buy.
Yep.
And the monitor is where you just kind of look over your account, that kind of stuff.
Yep, exactly. I know I've been doing most of the talking here. So what I'm going to do is I'm going to copy this layout. Okay, this is going to be my exact TOS layout and now Josh's. So just click the link in the description below, download my TOS layout. And then if you go to setup, you'll have it right here, the Daily Traders TOS layout. So there are like a couple smaller intricacies as to how to set up TOS. When it comes to the drawings, the trend lines, I have just, very minor customizations. Like when we draw a line, well, instead of that being red, I like it to be like this and white and size 2. Okay. So like some smaller stuff like that. All right, let's cover just a couple tools we're going to need in our trading. So under drawings, drawing tools, trend line. Now trend line, if you click anywhere on a chart, it's going to let you draw out and essentially figure out what the percentage is going to be between a certain point and a certain point. Okay. So like, for example, if we drag off of the low, so click and drag up to where we're currently trading, which is right here. See the green 66.28.
So is this the 180 day?
Yeah, this is the 180 day.
83, okay.
Yeah. And then if we drag up to 66.28, that is where we're currently trading, okay? So that is, 7% above that low at 61.47. You see that, right? We'll end up utilizing that tool a bit more later on.
So those are really the only two drawings you use?
Yeah, the only two drawing tools I use. Trend line and then the price level. And then again, just zooming in, zooming out. Pretty straightforward. But yeah, click and drag to zoom in. So it's pretty straightforward to use. Again, we'll get into monitor, activity positions, all of this stuff later on when we're actually trading. But for charting, this is all we're going to need, okay? 4 hour. Looking back over the last 180 days, we've got our couple drawing tools we're going to be using. We've got our simple moving averages and our exponential moving average. So make sure you go ahead and apply the 2 simples and the exponential on your chart if you're on a different platform, or you just copy my layout, clicking the link in the description and applying it. Any questions?
No, that's pretty straightforward.
Again, simpler is always better in my opinion. I don't have 80 million graphs, charts, different indicators pulled up because it's just not necessary. Okay.
Keeping it simple.
Keeping it simple. Questions?
So you add the stocks to the 2023 watch list as you're going along and finding ones that look like they have potential?
Yeah. So if I find a stock that I want to look at and keep an eye on or do some further technical analysis on, you just click symbol and then again type in the ticker, whatever you want. So like Microsoft. And then, I'll kind of add and remove. Just click on it and delete it to remove it as I go.
Where do you go to see the rest of the stocks? Like if you just want to scroll through.
Okay, good question. So if you go under, click on the current watch list we're on, public E, N, R, all of these. So
so then
you can see here we've got the different watch lists. These are like the default watch lists. So let's see, public NR. You've got the Russells, public SW. You've got S&P 100, 400, 500. So say we click on the S&P 500, you can even drag this down. And so click on a ticker and then you use just the down arrow and you can start scrolling through and looking at all of these stocks.
Simple enough.
Yeah. All right. Any other questions?
Nope.
Makes sense.
That makes sense.
So that is it. That is our Thinkorswim layout and setup. We are ready to go about trading.
I'm excited.
You excited?
It's easier to follow now. Less stuff we're looking at. Let's start trading.
Let's start trading. I'm ready to get into it too. So if you guys are interested in following along with this series, learning how to trade with Josh, make sure to subscribe to the channel. If you are interested in my mentorship group, the first link in the description below will take you over to the website. You can see everything that is included and apply if you are interested. Josh and I will see you next week. Peace. This is part 3 in the series where I'm going to be teaching my friend Josh how to become a consistently profitable trader in the stock market. Now, over the coming months, Josh will be learning my entire trading system. Essentially everything that I've learned over the past 7 years in various markets. My goal is to not only help Josh, but also help you. So if you've ever wanted to learn how to trade, we're going to be posting a new episode every Friday at 3 p.m. Eastern Standard Time. Now, the most effective way to learn with Josh is to go back and start on part 1 just so you don't miss anything. Now, Josh, trading is broken down into 3 main parts. Okay, 1 being trading psychology, 2nd being risk management, and the 3rd being technical analysis or fundamental analysis. So the actual trading itself. How are you deciding, which stocks to trade and what direction to play that stock? Does that make sense?
That makes sense.
Now, my goal with this series is to cut out all of the fluff and only teach you exactly what you need to know, because there are thousands of different ways that you can go about trading. Now, the first couple weeks are going to be spent really just diving into the basics and getting you to the point where then I can send you out on your own, give you some homework, and then we can touch base and you can actually progress throughout the week instead of just in the 1 hour when we sit down to record this video.
It's like going back to school.
Yeah, exactly.
Gotta have some homework, stuff to do.
Do you know what we're going to be working on today?
Support and resistance.
That is correct. Support and resistance. Nice. So without a foundation and a fundamental understanding of what support and resistance actually is, you're going to be lost from the start. So let's hop on inside my computer and I'll show you.
Let's get it.
All right, so let's talk about the fundamentals of support and resistance. Do you know anything about support and resistance?
So if the candles are above, one of the lines bounces off, is that...
Okay, let's just break this down. So think of support as a floor and think of resistance as a ceiling.
Okay.
I'm gonna be giving you some examples. We're gonna chart out support and resistance. I'm gonna let you chart it out, and then we'll talk about the difference between, support and resistance within a candlestick and then support and resistance when it comes to the moving averages that we now have on our chart that we applied last week when we set up our TOS. For basics, right? You wanna think of support as an area that when price is falling, price will hit that floor and bounce off of it. In the reverse, when price is pushing to the upside,
it's that ceiling.
It hits that ceiling
back down
and comes back down. Now, based off of the time frame that you are trading on, there will be different support and resistance levels. Because we're going to be doing all of our work on the 4-hour time frame, we will just be working on the 4-hour to identify these support and resistance levels. Just know that there will be levels of support and resistance on each and every time frame. Okay, if we're on a 1-minute time frame, we're looking at the day. Okay, you can see pre-market and aftermarket. So when we're looking at a 1 minute and we can only see the day, well, we can look to see what was the highest price we were trading at and what was the lowest price. In this case, the highest price that ticker symbol ON was trading at today was here at 66.82. This is called a wick. So at the end of each candle, these are called wicks.
Okay.
That's a wick, and this is the body. So this is the body of a candle and that's the wick. This was the highest price ON was trading at on this day. And we can see price is currently moving right now. This is where we're trading at right now. So if we just draw out, again, under drawings, drawing tools, and then trend line, we just mark our, what is this? What level is this?
The highest.
So what is that, a support or resistance level?
Resistance.
Resistance. And then on the other hand, the lowest price that we were trading at today.
The floor, the support.
That's the support. So we can just draw that out. We've got what I would say is our daily resistance and our daily support. That is on a 1 minute time frame. So if we hop over on 4 minute time frame, you can see the candles now representing 4 hours. And then if we go over to 15 minute time frame, you'll have different support and resistances on the 15 minute. You've got the all-time high, all-time low on the 15 minute. Now the all-time high and the all-time low, if we go back to the 4 hour, those are what I'm going to consider our strongest support or resistance levels. Some people like saying key levels. So you could have key levels within a daily time frame, a weekly time frame, but on our 4 hour, I would say the key levels are going to be that all-time high and that all-time low.
And you just use the 4 hour.
And I just use the 4 hour for all my trading. Yeah, but you can see, and just feel free to interrupt me, you can see that we're trading closer to that all-time low. So this is going to be a key level of support that we can go ahead and mark, right? Go ahead and click on the trend line drawing tool, and we've got our support level. And we've got our resistance level up here, but you can see this resistance is so far away from where we're currently trading. If we go to drawing tools, click on this little trend line tool, you can see the green 66.59 where we're currently trading. Click and drag up to our resistance, and you can see 40.21. So we're sitting 40% off of our, what I would call an all-time high on the 4-hour time frame, or an ATH. So that's our ATH, and this is our ATL, all-time low. And we are sitting, we click and drag, 7.73, about 8% off of our ATL, so our all-time low on the 4-hour time frame. So those are our like major key support and resistance levels. Now within, we keep looking in a little closer, and we kind of zoom in further. I would say zooming into the immediate trend. So like if we look at the immediate trend, you can see obviously all of the black areas are a trading day. So if we look at say the last like week and a half, you can see the date here. This was October 20th. Now looking at the immediate trend, we'll have support and resistance levels within the immediate trend. And so obviously being aware of that ATL, got support at the all-time low at 61.48. But what we're going to be looking for are pushes. Now there's going to be resistance on a push and support on a pullback. And if we look at a 1 minute time frame or a 5 minute time frame, we can see resistance on a push, support on a pullback, resistance on a push, support on a pullback. You kind of get the idea here.
Yeah.
So what we want to look for is, this is support on a pullback, resistance on a push. We got a little resistance. Okay, pulled back, broke through resistance, pushed up. We formed some resistance in this area. As we look at the top of the wicks, right, we've got
the different
68.95
of the wicks. What does that do? Do you use anything like that?
Okay, no. So some people will trade off what's called a candlestick pattern. That's like a preconceived pattern, looking at candles and saying, hey, this candle closed and it looks like this. Like the wick is smaller than the body, or, we closed 2 red candles in a row and the next one was followed by a green candle that was bigger than the previous red candle, and that means the chart's gonna go up.
Don't do that.
Nonsense.
Yeah.
That doesn't work. Okay, that's just 50-50. Toss a coin. So takeaway here is there will be different support and resistance levels based on the time frame. We're going to be doing our work on the 4-hour time frame, and that is where we're going to be identifying our support and our resistance. Support and resistance, when it comes to my trading, is going to be used for when it gets to the point of saying, hey, I'm betting on the stock, whatever the stock is, to go up. Based off of where that support and resistance is sitting on the chart, well, then I can figure out this is where I'm going to be wrong and this is where I'm going to be right. Or this is where I'm going to be right and this is where I'm going to be wrong. Support and resistance is going to help me set up my trade plan to then realize or figure out really in the first place whether that is a trade that I can actually take or not, based off of many factors that we'll get into. So essentially what we want to do is look for the highs and the lows on a chart and draw our support and resistance levels. So for example, here we've got our all-time low. We know that is support. And then it looks like we're trading at 66.63 right now. We had resistance found around this area, roughly right at, let's do this, double click, edit properties. Let's see, show price on right, save as default. Okay, if you don't have that yet, do that. Okay. So 68.96 roughly. You can see we pushed up, wasn't able to work our way up during aftermarket, and then rejected again during pre-market. And then Monday last week, again, rejected. So the more tests of either support or resistance are going to further confirm that level as being, well, valid or strong or holding, however you want to say it. Say you're betting on a stock to go up and you identify a support level below.
Yep.
Well, the more tests of that support level, the better, because if you set your stop loss, and your stop loss means that if this stock trades down to this area and breaks below this price, right, whatever that price is, that is when I'm wrong. That is when I'm out of this trade, because it'll continue to fall down to that next support level. So the more tests,
the more times it bounces off either the support or resistance, either or, depending on what you're shooting
it's
for.
showing like how strong that area is.
Okay.
How strong that area is going to be acting.
That makes sense.
So when you go to set up a trade plan and say, hey, this is where I'm going to be wrong. Well, it's going to help if you have more tests of that level than not, because that's just going to give you more confirmation that that level will hold. So we've got, roughly 1, 2, 3, 4, let's say 4 or 5 tests of this level acting as resistance. Okay. And then, the following days after, we continue trading a little lower each day. And then Friday, it looks like we did end up pushing a bit and then pulling back into today. So our next clear level of resistance, I'd say, is at 68.96. However, okay, it looks like there was a little resistance formed last Tuesday, which was then broken Friday, and then Friday's daily high at 67.87. On the 4-hour time frame, there will be a little resistance there just to keep in mind. So you'll see on each day, there'll be support and resistance levels, right, on each day. So looking at this chart, we can see, hey, there's just this clear level, right, of resistance, and then this clear support. And then we can kind of chart up and say, hey, roughly, let's see, how far above is our resistance? Okay, generally about 3%. Now, that is finding support and resistance when it comes to looking at the candlesticks. So what I want you to do is go through a couple of charts, and let's start on the 1 minute just because it's going to be a little easier. And I want you to identify our daily low and daily high and draw out either the support or the resistance level. Well, both. You can go down and look at the S&P 500, and we're going to start on the first stock, and all you have to do is hit the down arrow, and then you're going to look at today and say, hey, okay, this is our daily high, this is our resistance, and then let's find our daily low. Where's our support going to be? Okay, and this one, in this case, you can see like there's low volume. We'll get into what that means later on, but that's why the candles look very weird. There's essentially just less people trading this stock, so there's these weird gaps.
Oh.
There's these weird gaps in the price, okay? So it looks like pre-market gapped up. That looks like the lowest price at which we've been trading today. And just very roughly, briefly, right, off of the open. So we're not looking at pre-market, okay? We're just gonna look at
For the day.
For the day on, off of the open. So go through and we'll chart out some daily support and resistance levels on the 1 minute. So, okay, we got our daily high at 157. What is that? What's that called?
Oh, the resistance.
Resistance, good.
Sorry.
You're good.
And then support is down at 936.
Yep. Zoom out a little, just so we can see the full day, just to make sure. Good. Awesome. Okay, next one.
So we're looking at 265 for the high, for the resistance.
Yep.
Around 259.
Support, good.
Support.
Yeah, so a little rally off the open. Now, once you mark that, pause on this chart.
Okay.
And let's say we're trading at right now 78.32. Let's see where our other support and resistances are going to be, because I see where we've had many tests of an area. If you zoom out a little bit more, you see this area?
Oh, yeah, right here.
Look at it.
Keeps bouncing.
Keeps bouncing off that area. So in the immediate term, that is going to be our next clear level of resistance. Right? Yep. And then where's our support going to be?
Support's going to be great.
There you go. Okay. So that could give you an idea for what I would call your margin for profit. So if you were to enter now, and this would be a day trade because we're on the 1 minute, you could say, hey, I'm going to go long. I'm betting on the direction of the stock to go up. I'm going to take profit if I hit 78.57, and I'm going to stop out if I hit 78.19. Does that make sense?
Yeah, that makes sense.
Or if that margin is too short, then you could say, hey, I'm going to stop out if we break the daily low at 77.98. Or I'm going to take profit if we hit 79.56. All right, so let's go back to the 4-hour time frame. I think you understand.
Yeah, that makes sense. Pretty straightforward, I feel.
Now, on the 4-hour, I like saying this, the cleaner and the clearer the chart, well, the easier it is going to be for us to actually identify where those areas of support and resistance are. So a choppy chart where the overall direction is unclear is going to be harder to identify where those support and resistance levels are. So 2 words you should know: trend.
Trend.
What's trend? Do you know?
It's just, what's the, I don't know how to explain it. I know what trend is, but like.
The overall direction. So the direction of a stock. Now there's going to be different trends based off of either time frame you're looking at. So if you zoom out all the way, which you are right now, we can see the trend of this chart. And this one was even a little harder to identify what the trend is here, because think about it like this. If the chart is moving from the bottom left to the top right, that is what is called a bullish trend. Whereas if it's moving from the top left to the bottom right, that is a bearish trend. So bull market, market's going up; bear market, market's going down. Okay.
Makes sense.
And then based off the time frame you look at, the direction is going to be headed in different ways. You can identify the trend on different time frames. I want you to look through a couple charts. I want you to try to identify a chart where the trend is very clear. So where there's not a ton of chop. Like this Netflix, very choppy. We want to find a chart that is presenting a very clear trend where direction is very clear. And then I want you to tell me what the trend is. And then within the trend, I want you to identify the support and resistance levels. All this on the 4 hour.
Okay.
That looks good. Okay, there we go. That's a pretty clean chart overall. So overall direction or overall trend is what in this case?
It's bearish.
Down, bearish, good. And now within this overall trend, if we look at the last month, okay, so kind of zoom in, can we identify some areas of support and resistance? It is a little choppy. So one thing you want to keep in mind is like when we go to actually trade, well, we're not going to be even having to take into consideration in this case, like the all-time high on a chart, because that is going to be sitting so far away from where that stock is currently trading that it's never even going to come into play, or the all-time low or another area of support or resistance. And that's why we're looking at the more immediate trend. Does that make sense?
Yeah, that makes
like
sense.
You're not, if you put on a trade and say your average hold period is going to be 3 to 5 days,
the stock's not going to go up or down 40%.
Yeah, we're not even going to ever get to that next, that 5th, 6th, 7th strong area of support, 25, 30% above where we're currently trading. It won't ever come into consideration in the trade or in the trade plan when we're making that plan for the trade. Yeah, it's pretty choppy. And so
when you zoom in more,
I won't even trade charts if it's too choppy and I can't identify where I'd set my support and resistance levels. Sometimes you just can't identify where there's clear support or resistance, and therefore you can't set like a trade plan. Again, when I say trade plan, I mean like this is where I'm going to be right, this is where I'm going to be wrong. Yeah, see, you can see a lot of charts right now because of where the overall market is sitting and like how the market's been. It's been all over the place. It's been a lot more choppy. It's a lot harder to find like very clean and clear charts where you can easily identify those, areas of support and resistance. Josh and I just wanted to quickly interrupt to mention that this series could take anywhere from 6 to 12 months. If you really want to fast track your progress, if you want to have access to essentially all of the information at once, where you could really get through what I'm going to teach Josh in a week, well, I put together a curriculum covering everything I've learned after trading over the last 7 years. That curriculum is all inside my mentorship group. And in addition to that, one of the things that I also offer as a coach and mentor, and now I've been doing this for a couple of years, is giving people the ability to essentially sit over my shoulder throughout the day and see the exact trades that I'm taking in the market. Whenever I'm putting on a position, right, I'm posting that trade to my group. I'm saying, hey, these are the option contracts that I'm buying. And then when I go to close that trade, I'm either making money or losing money. So full transparency. So I know for the people that just don't have the time to learn, or maybe you'll set aside the time to learn in the future, then being able to kind of have this direct route of making money in the stock market, well, my callouts inside the mentorship group are gonna give you access to do so. There is a lot more that is included in what I offer. I'm actively coaching every day. I'm online. And so if you wanna learn more, just click the first link in the description below. Head over to my website, see what's included. And if you're interested, it is application only. So go ahead and fill out that application. And if you are accepted, I look forward to hopefully working with you. So now I wanna talk about moving averages, because we've got these 3 moving averages on here, the 180-day, 50-day, and 15-day. And those moving averages are also going to act as support and resistance levels. I like to say that the moving average is going to be either respected or not on a chart. So if you can see that price movement, and when I say price movement, you just look at the candles. If candlesticks are trading through a moving average, that means that that moving average is not being respected. In general, the 180-day is going to be acting as either the strongest support or resistance, followed by the 15-day, and then the 15-day EMA being the weakest support or resistance. If price is trading, if the candles are trading above that moving average, that means that moving average is going to be acting as support.
It's going to be the floor.
It's going to be the floor. And if the candles are trading below that moving average, that means that that moving average, whatever it is, 50-day, 180-day, 15-day, is going to be acting as the resistance. And then just like looking at support and resistance when it comes to the candlesticks themselves, well, the moral tests of a moving average, either acting as support or resistance, are going to help further confirm that that level is respected. That's what I like to say. So let's look through some charts and try to find a chart, identify the trend, and then look to find a chart that also has moving averages. Yeah, and the moving averages are respected. Exactly.
Would this be it for this one? Because it's respecting the 180.
So the longer period of time that a moving average has been respected, the better. And remember, we talked about like knowing that, hey, if we're setting a trade plan, like realistically, maybe we'll look for a percentage to 5-6% move on the chart. But if there's an area of support or resistance that's sitting 10, 15, 20% overhead or below, whatever the case is, then we don't really need to even take that into consideration. So like example here, if we look at the immediate trend, you look at how long it has been that the 180-day has been respected on CSGP. And I would say that this chart is too choppy for me and I would just move on. I wouldn't even look at it. Can you kind of highlight so people can see? Yeah, just circle with your mouse where our areas are that we've tested and been rejected, right? Let's be a little more specific.
Here.
So here,
Here.
here,
Here.
and then right now,
Here. Well, if it broke through, then
what the market likes to do, and this is something that I'm going to say a lot, is the market likes to probe levels and shake out buyers or sellers. So think about it like this. There's so many people out there trading. So many people looking at the same chart. They could be looking at the same moving averages, same time frame. Think about where most people are going to be setting their areas of this is where I'm right, this is where I'm wrong. Someone goes short on this chart. Well, the majority of people are going to be looking to get out of that trade. That's where they're going to set their stop loss at the 180-day. But what the market likes to do is it likes to probe these areas of either support or resistance and shake people out and then retrace. And this is something we're going to talk about in more detail in the future. But that still means this area is respected. Okay.
okay.
Broke above,
Came back down.
shook people out, right? Everyone who had their stops set right there. Their stops got hit. They got out of the trade. They lost money. And now we've pulled back below the 180-day. Let's look at another chart. Let's try to find a little cleaner chart. This is a good one. Okay, so we can see if you zoom out all the way on this chart. Wow. Okay, so 48.72 is our all-time high. All-time low is 24. You can see the dates here. Okay, since July, August, about mid-August, we broke back below the 180-day, and since mid-August, we've been trading below the 180-day. So in the immediate trend, the 180-day is respected. Let's look at the 50-day SMA, and you can zoom in more to see if the 50-day is respected. No, it doesn't look like the 50-day is respected. Candles are trading straight through it, and the 15-day is not respected either.
So ideally what you're looking for is it's respecting all three.
Good question. So I guess this is maybe a good time to summarize like my trading as a whole. So quite simply, I'm a trend trader. So what I'm doing is I'm looking at the larger trend. Okay, in this case, a 4-hour time frame. I'm identifying what is the overall direction of that stock. And then within this 4-hour, we're using these 3 moving averages as reference points. And what I'm doing is I'm looking for patterns within that chart. I'm talking about historical patterns. Now history repeats itself. You see a stock that has formed the same price movement, price action, however you want to say it, a stock that has repeated that same pattern multiple times. Well, based off of that, I've done back testing and figured out if I look at a chart and I identify this is the trend, these are the moving averages that are respected, and the 180-day is going to be the moving average that is the main one, which I'm going to be looking at when it comes to identifying within that trend if there is a pattern. Within that pattern, is there a setup or not? And a setup, when I say setup, I'm looking for certain criteria to be checked off. And then if that criteria is checked off, well, then that is a trade that I've taken many, many times over and over. And I know the expectancy behind that.
Yeah, you know what the results should be based off history.
Yeah, we're heading in that direction, right? Over the next couple months in learning. But no, you don't need every moving average to be respected. The 15-day is the smallest time frame. Average price movement over the last 15 days. I will use that only typically as an exit, not an entry. I'll use that as an exit. That entry is going to be the overall pattern, trend, right? Everything I just kind of referenced are going to be trade management moving averages. As in, this is where I'm going to be right or wrong.
Kind of like
this is where I'm setting my stop loss or take
trade after I place it.
This is all stuff that we figure out beforehand.
Okay.
Before we ever get in a trade, we want to know exactly where we're going to be wrong and where we're going to be right, and how much we're going to make if we're right and how much we're going to lose if we're wrong. And by using the 15-day and the 50-day SMA, typically it'll be those two smaller moving averages. And typically those will be the levels at which I will be wrong based off of the setups that I have. Well, that's going to help us decide, well, is the risk to reward behind this trade worth it? Is it worth taking this trade? Am I, risking as much as I should be according to my system to then make X amount? You see how we're getting into a lot here, because it's hard to answer one question without answering a whole lot of questions. And then sometimes it'll be the 180-day where I'm either going to be, if we hit that level, the 180-day based off the setup, Maybe it means I'm getting out of the trade there, or maybe it means I'm taking profit there. But at the end of the day, the cleaner and the clearer the chart, the better. It's just going to help us decide whether there's a trade there to be taken or not.
Okay.
But right now, I don't want you to get overwhelmed. We'll get to all this. I know it's a lot. I just want you to be able to identify support and resistance levels when it comes to the candles, and know that, looking at a chart, being able to identify real quick, are moving averages respected or not. Does that make sense? So on this chart, I want you to draw our support and resistance in the immediate trend. When I say immediate trend, I'm talking the last 2 weeks to 1 month. That's like the immediate trend. Where's our support? Where's our resistance when it comes to the candlesticks? And where's our support? Where's our resistance when it comes to the moving averages? So looks like I'm not going to say anything. Go for it.
Well, okay. Question. Would it be, because that's like slightly above. Does that matter?
That's going to be another resistance level.
Yeah. So, okay. So these two would be different.
That's a daily resistance level that has, we've got one test of that. That was the highest price that JD traded on, what was that, Monday, a couple weeks ago. So there will be some resistance there. And you'll see there's many small support and resistance levels within each trend, within these patterns, right? We'll get into what I mean by pattern and what I mean by all of this later on, okay? And a lot of this is stuff that I'm gonna be repeating, reiterating, and that you're gonna continuously practice as we go along.
Okay. Okay, so this is the resist or the support, right? Because it bounced off here.
Okay. So you can see we broke because we're looking back at the past. You can see, yes, there was a little support there. For this day, there was support there. And then this day, that would still be support. And then this day, well, we broke through that support.
Okay.
And so now there's no more support there.
So it doesn't matter.
It's broken. But here, you can start your line there. I wouldn't go back through here, right? But now there is some support that was just formed, right? It just happens to line up with that last one.
Okay, yeah, so that's, once it breaks through,
so once
it's irrelevant.
Yeah, because we're looking at the past price movement, right? How candles have moved on the chart. So if you picture, now moving forward this way, well, this is going to be our next clear support at 25.19. Our next clear resistance at 27.57, good. We've got another resistance level above at 27.91. We've got the 180 day, which has how many tests? How many times have we tested that? Or how long have we been trading below the 180 day? What we're trying to do is determine, will the 180 day SMA be acting as
since
a resistance area? So we've been trading
since August,
below the 180 day since August. So that means that 3 months where price has yet to break back above the 180 day. We haven't had any direct tests of it. We've kind of rallied up, here. Looks like we started to work our way up, but I would say that is going to definitely be acting as a resistance level. Pretend we know a lot more than you do right now, but let's just say because of X, Y, and Z, we're going to bet on this stock going down. But where we're going to be wrong is if we break back above the 180 day and we break over it. Because then if we break above the 180 day, well, now the overall trend, the pattern has just shifted. 3 or 4 months we've been trading in a bearish trend, right? The trend's been bearish. Overall momentum has been to the downside. We can see the chart has, been forming lower lows, and lower highs is something you're going to look at too. So a chart that has lower lows and lower highs is going to be a bearish chart. So that's good. Okay. You've identified, okay, we got these resistance levels overhead. 180 day will be acting as a resistance level as well. Our support, 25.19, small area of support. Again, these are very small areas of either support or resistance. We've got, this all-time low at 24, which we've had multiple tests of. That's going to be a really strong area of support. Good. I like it. Awesome. How are you feeling?
It's good.
I know there's a lot, and I'm going to give you some homework. And your homework is going to be to go through. This is the NASDAQ 100 that we're on right now. I want you to go through every stock over the next week. You have a week. Okay. Again, you're going to be progressing slower than someone who would say jump in the mentorship group and start taking the master class right away. But I'm giving you a week's worth of homework, which is really only going to take you a couple hours. Go through all the stocks in the NASDAQ 100, and I want you to go out and go to the immediate trend on the 4 hour, like we have been. Look over the last 2 to 4 weeks. Okay, what's the overall trend, overall direction, right? Bearish or bullish? Are moving averages respected? And then go about charting out your support and your resistance levels. And you got to just practice this. You will get so fast at it where you can just go through charts and see like right away. It'll become second nature to you. And so that's what I want you to practice, and anyone else. You can spend the next week practicing this.
Okay.
Good.
Let's do it.
How are you feeling so far?
Feeling good.
Awesome.
Yep. feeling more confident.
All right, so again, if you guys are interested in gaining access to my mentorship group, the first link will be in the description below, where you can then go ahead and apply. Josh, I'm so stoked for this.
Me too. It's gonna be a fun next 6-ish months.
We'll see how long it'll take, but we'll get you there. If you guys are interested in following along, again, don't forget to subscribe and smash that like button. And Josh and I will see you all in next week's episode. Later.
Peace.
So today I'm going to be teaching my friend Josh my trading strategy for technical analysis in the stock market. Now, if you're just tuning in, this is actually part 4 in this series where I'm teaching you how to become a consistently profitable trader. Now, if you're just tuning in and you want to start on part 1, we will put the link in the description below to the full playlist of the series. Now, before we get started, I want to briefly mention that if you are out there and you are looking for a mentor to help guide you into that consistent profitability within the stock market, then I do offer a mentorship group. Now, not only will you receive access to an entire curriculum covering my whole trading system, essentially everything that Josh is going to learn in the coming months, you'll also have access to see my exact trades. So it's like the equivalent of sitting over my shoulder throughout the day. So whenever I'm putting on a position, I'm posting that entry, and whenever I'm closing that position, I'm posting that exit. If you want to learn more, the first link will be in the description below, where you can go ahead and apply. With that said, let's hop on inside my computer and get started. So how did your homework go?
The homework went good. You can put in a clip of this. This is like my first time using OBS. Okay, so I just filmed for 30 minutes, me doing the homework that Mark told me to do. But I didn't know how to use OBS, and it was just recording like the top little corner. So we're gonna redo this. So time lapse, go. And then I had to reshoot it all, but it's okay, it went good.
Okay, what you did was you went through, what, 100 charts in the NASDAQ?
Yeah, I went through the NASDAQ, and then I actually went through with my girlfriend on hers as well, so.
Awesome.
And I went through back and forth.
All right, so today we're gonna really be diving into the way I go about trading. Patterns, trends, setups. We're gonna talk about all of the TA is technical analysis, that I do to actually decide what direction to bet on a stock going. Make sense?
That makes sense.
So this is gonna be loose, and we'll kind of just, we'll hop right into it. So for starters, I like describing myself as a trend or a pattern trader, right? So essentially what I'm trying to do is I'm trying to first identify a trend. Now I do all of my work on the 4-hour time frame, okay? So first, identifying a trend. Second, within that trend, trying to identify any patterns, and we'll go over examples of all of this. And then I use 3 moving averages, the 180-day SMA, the 50-day SMA, and the 15-day EMA. Okay, and by doing all of that, I'm able to find what I like to call setups within charts. So I trade 4 setups. So those setups are kind of an accumulation of both identifying the trend, the patterns within that trend, using these moving averages as reference points, if you will, and taking all of this into account and looking at a chart and saying, hey, I've seen this chart, exactly what this chart looks like I've seen, say, 20, 30, 50 other times, right? Because we can see based off of the way a chart is reacting to the moving averages, based off of the pattern, the historical data that we've seen on this chart and how this chart has played out, right, over the last, in my case, 180 days, because I'm on the 4-hour looking over the last 180 days. So in the last episode, we mentioned, those restraints that we're kind of working in being the all-time high on the chart and the all-time low. A couple on my setups, what I'm doing is I'm trading around that all-time high or all-time low.
Okay.
Does that make sense?
Yeah, seems pretty straightforward.
Okay.
So it's stuff that you can go back on and like you said, you've seen it a bunch of times and
yes,
you know what you're looking for.
Yeah, so the idea is that I'm not looking for like candlestick patterns. I've said this before, right? Like bull flying bear flags. I like making jokes about the like preconceived, I call them candlestick patterns. Within this trend, I see patterns that have played out many times on this chart. And then we're gonna get into talking about moving averages and seeing whether they're respected or not. So we're gonna be using all this information to essentially be like, this is a setup, one of these 4 setups that, I'm going to be looking for when going through charts. And then we can kind of check off the boxes, if you will, as far as the criteria that we need to validate an entry behind that setup on that chart. So if we're going to take a trade or not. The setups I have both work in bear and bull markets, which means that no matter if the market's going up, if it's going down, I can always capitalize on any market condition and make money. Later on, we're going to get into those setups specifically and cover 4 of my setups. But today I really want to go over essentially the basic rules for finding these setups. Okay, so we're gonna share my screen and we're gonna hop right into it. And just feel free to interrupt me. I'm gonna give you some examples, kind of cover the criteria that I'm gonna look for and the rules that you need to follow to find setups.
Okay, sounds good.
All right, so at this point you have like a solid foundation, I feel like, as far as being able to identify both support and resistance levels within using, I guess, candlesticks and using moving averages.
Correct.
Right? Do you feel pretty good about that?
Yeah.
And it took you like what, an hour?
Yeah, it didn't take very long, probably an hour.
That is kind of the step one, right? Obviously, we covered that in the last video, being able to identify support and resistance areas on a chart. So that's good. So today, let's talk about, I guess, first things first, moving averages and whether a moving average is actually going to come into consideration, I guess, when looking at a chart or not. And I like using this word respected. Using this example on ILM, now this is actually a trade that I'm currently in. I think I'm up. Let's see, I'm up 2.2K on this trade. I'm down 1,000 on the day, but I'm in this trade right now, up whatever, a couple thousand. And let me ask you first, what's the trend?
Down.
Down. Okay, it's bearish.
Bearish.
So it's a bearish trend.
Bearish trend.
All right, and now when we're looking at these moving averages, do you remember what this one is? The green?
180.
180.
SMA.
SMA. 180-day SMA.
And then 15-day EMA is the blue.
Yeah, so 180-day SMA, 50-day SMA, 15-day EMA.
So 180 days the strongest, 50 second, 15 least.
Strongest in what sense?
Strongest as in like if it's below it, resisting if it comes up and hitting it, you mean? Like that, like resisting it, and then if it was above it, supporting it.
Okay, so if price is trading below either moving average, right, whatever moving average it may be, that moving average is going to act as a resistance. On the other hand, if the price is trading above, it's going to act as a support.
Correct.
Okay, good. Well, how do we know if a moving average is actually going to act as a support or resistance? How do we know if that moving average is going to be valid when it comes to using that to determine whether there is a trade to be taken or not? Do you have an idea what I mean?
Based like on the past, like if it's supported or resisted in the past.
Yeah. So
and how many times it's done it.
Yeah.
Okay.
So respected or not. If you see a chart
respected, that's the word.
That's a like kind of good word to summarize it. So for example, ILMN, this is a chart where moving averages are clearly respected. Now, really, we're just looking for the 180-day and the 50-day to be respected. Those are the two moving averages that are going to correlate to actually looking at a chart and being like, all right, that is part of the criteria that I'm looking at, making sure that the 50-day and 180-day are respected to then validate an entry, like whether there's a setup there or not. Whereas the 15-day, that is going to be used as what I like to call a trade management moving average. So that will really only ever be or come into account when it comes time to say, this is where my support is, my resistance is, whether I'm long or short, this is where I'm setting my stop loss and take profit. So that moving average is not going to be, a deciding factor in whether we should take the trade or not from a setup perspective, but it may be when it comes to determining where you're going to be right or wrong. Again, based off that trade itself. Does that literally just seriously interrupt me if this is not making any sense?
No, it seems to be pretty straightforward.
What does it look like on this chart? Would you say that candles are just trading straight through the 50-day or the 180-day and not respecting these moving averages? Or is the 180-day and 50-day respected on this chart?
The 180-day definitely looks like it's respected. And then, so does this matter if it breaks through like a little bit?
Okay, we'll get to that because I want to save that for later, but I can talk about that right now.
Okay.
So what the market likes to do is it likes to probe levels, probe areas of support or resistance, right? Key levels on a chart, and it likes to shake out traders. So think about however many people may be looking at this chart right now. They might be looking at the same moving averages on the same time frame. Now, everyone is going to go about setting their stop loss, say they're short and the chart starts to push, they're going to go about setting their stop loss right on the 50-day. The second that chart breaks the 50-day, they're out. So kind of putting yourself in the position of remembering that we're all potentially looking at the same chart. There may be thousands of other people with the same trade idea as you. Where are most people going to be getting out or getting in? And so the market probes these areas, it shakes people out, and then it remounts. And this happens time and time again. You'll very rarely see the market or whatever stock you're looking at perfectly touch, an area of, in this case, resistance. Say the 50 days acting as resistance. In this case, it is. Well, the market rarely hits that level and then, bounces off of it exactly at that point. You know, it normally probes that area. People get shaken out the second we break above the 50-day, and then you can see that hard retracement, that hard pullback. Yeah. So later on, when we get into actually creating our trade plans, that's something we want to remember, is that the market likes to probe areas of support and resistance. Think about where most buyers and sellers will be on a chart, and don't set your stop loss or your take profit, your SL or TP, right at that area.
Okay.
You want to give yourself a little room, a little wiggle room, if you will.
So it has the chance to probe and then either drop back down or bounce back up, depending if it's above or below.
Exactly.
Okay.
And I'm glad you got to ask that. All right. So on this chart, we can see the 50-day, knowing that the market likes to probe areas, right? Probe levels of either support or resistance and remount or reject, however you want to put it. 50-day definitely looks like it's been respected. So we could see before when, you know, price was just trading straight through the 50-day, it was not respected. We lost the 50-day, ended up breaking slightly above, you know, retraced below, broke slightly above for a little bit. The market was really trying to decide whether it was going to respect this level or not. And then boom, it looks like beginning of August, we really saw that pull below. Obviously rejection off the 180-day. That was a result of earnings, that volatility right there. And then, since August, we've been trading below the 50-day, okay? 1 test, 2 tests, 3 tests, and it looks like we're just going in for a 4th test, okay? So the more times support or resistance area has been tested, what is that going to tell us?
Stronger it is.
Stronger, right? Yeah. It's been 4 months, just about, of the 50-day being respected.
Very good.
And the 180-day, yes, it is, I would say respected since about May. Okay, you can see, you know, coming off that high at 238.55, ended up retracing, pulling back below, test, rejection, test, rejection, test, rejection, test, rejection, test. So we've, you know, really been in a downtrend. The overall trend is very strong here. Direction's very clear, right? 180-day is respected, 50-day is respected. Great. We checked that off our box. Now that is going to correlate to one of the setups we'll cover later on. In this case, the 180-day is sitting very far above where we're currently trading. Okay, we're sitting about 21% roughly above where we're currently sitting. So that won't really ever come into consideration if you're going to take a trade on ILMN. That's kind of a mouthful. Yeah. Try saying ILMN.
Was it?
ILMN.
ILMN.
You know, if you were trading ILMN right now too, you wouldn't really ever use that level. That area at the 180-day, it is respected. Yes, we know that will be acting as a very strong resistance level, as it has like quite almost been a year. You know, 8 months we've been trading below that 180-day, but it won't come into consideration in a trade plan. So does that make sense?
Yeah.
Okay, cool.
It's pretty straightforward.
No questions?
You answered all my questions I had.
Awesome. All right. One of the biggest things too that you want to look for when, you know, you're looking through charts is a clean and clear chart, right? The cleaner and the clearer the chart, it's just going to be easier. More than likely, those moving averages will be respected. It'll be easier to identify that setup, the patterns, set your trade plan, where you're going to be wrong, where you're going to be right. So this is a very clean and clear chart on ILMN, but we can look at, you know, let's just pop over real quick to like the NASDAQ 100. I think very quickly here, we'll find a chart that I would say is not clean or clear. It's very choppy. So CDNS, you know, a CSGP, where you can see none of the moving averages are respected.
Spikes and stuff, and
a lot of volatility, 0 moving averages being respected. So let's just go through a couple charts, and I want you to tell me literally, are moving averages respected or not?
Okay.
Okay. All right, go for it. Respected or not?
No.
No. Good.
No.
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 No. Again, no.
So you can see a lot of charts are not respecting moving averages. What would I do? Like, just knowing what I'm teaching you, like, would I trade one of these charts where moving averages are not respected?
No.
Like this choppy?
No, you can't predict it. There's too much going on.
Not necessarily predict, but I guess one of the boxes that we're looking to check off when it comes to most of the setups that I trade are, you know, the question is, are moving averages respected or not? Can we check that box off or not? Is the 180-day respected, yes or no? Is a 50-day respected, yes or no? Again, it's kind of based around the setup specifically, but in general, more than likely, I'm not going to be touching a chart that looks anything like this. Tell me.
No.
Now, like this chart is a little choppy, a little volatile. You can see we got the high at 219.50, low at 184.69. There's a weird looking chart.
180 came out of nowhere.
180 came out of nowhere. I wouldn't touch something like this.
No.
Maybe go back.
Maybe
the 180 day, we did drop below. It definitely will be acting as an area of resistance, I think, but we haven't really seen any clear tests of it.
How far
so it's
back
hard to
do
say
you
if
look?
it's respected.
Like 4 months?
Yeah, that's a good question. Well, think about it like this. So if your average hold period on a trade is, say, 3 to 5 days. So essentially when you put on that trade, you're either going to hit your stop loss. I'm just going to say SL or TP moving forward because that's easier. You're either going to hit that SL or TP within 3 to 5 days. So you're either going to get stopped out or end up taking profit on that trade. When you look at a chart and you kind of see the ranges, so you can really draw out the percentage from where you're currently trading to an area of resistance or support, kind of taking into consideration how volatile a stock is. What is the average daily movement of a stock? So you can kind of see some stocks on average will move about 0.5% a day. Some will move about 5% a day. More than likely, swing trading in the way you're going to go about learning how I trade, kind of what we're doing right now, I'm really never going to set a trade plan where my SL or my TP is so far away from where we're currently trading that I would need to even take into consideration an area of support or resistance formed 4 months ago. It's more of the historical data and seeing that price has played out time and time again. Obviously, the more tests of a support or resistance level are further going to validate and confirm that area actually holding. So if we can see a chart has been holding below the 180 day for many months, or the 50 day for many months, and especially we can see we've had tests of that area with rejections, that's really just going to validate if we do set a trade plan up based off of one of those moving averages, or we take a setup. Because think about it, if you were at 41.98, say it's trading at 41.98, well, is it really going to matter, is the area of support going to matter up there? No, because, you can draw it out from where we're currently trading to up there. Essentially, you're not playing moves over periods of months where, if this was going to be a position you put on and it's headed to hold for the next 2 to 3 months and you wanted to play a move all the way back up to that all-time high, then sure, you want to keep it, pay attention to what was happening 4 months ago. But generally, when I say looking at the more immediate trend, in the more immediate trend, which is the last month to 2 months, that is where I'm looking to see moving averages really be respected or not. And then obviously the further we can see that they've been respected back over the last 180 days, that is just going to further validate that trade is going to be a really solid trade. Make sense?
Yeah.
Respected or not respected, does that make sense where you can look at a chart and, within probably 5 to 10 seconds, identify whether averages are respected or not, right?
Yeah, so this isn't really probing, right?
No, because here's the other thing. If
that
you want to
broke
zoom
through
in,
and it's been...
It very clearly broke through, and you could kind of just see it was about a week and a half to 2 weeks that we were actually trading below the 180-day SMA. Also, we saw earnings on Monday. Looks like pre-market. That's what that blue little light bulb is. So a stock, there's 4 times of the year, Q1, Q2, Q3, Q4, where a stock will essentially have what is called their earnings call. The company will come out with their data, how well they performed, how much the company made or lost within that quarter, and that will cause and create a lot of volatility within the stock itself. So I'm never gonna ever trade a stock through earnings. Okay. There's reasons why to not do that we could talk about later on, but the biggest thing is that there's just going to be a lot of volatility. The stock could shoot up 10-15%, whether earnings are in the morning or at night, or pull back. All of a sudden that stock just gets slammed 20%. I've seen that a lot of times. So your positions are just going to be on this roller coaster where you don't want to ever trade earnings.
It's all skewed up.
It's playing earnings or trading earnings is a coin toss in my opinion, and it's just not the right move.
Okay.
Just don't do it. But you can see when we're looking at a chart, if you see those blue light bulbs, well, that's where earnings was. And you can see a trend that had been a very strong trend, or you see this pattern that had been forming over a long time, or moving averages were respected over a long time. That can just be broken in a second after earnings.
Yeah, look, it dropped so much.
Yeah, so we had been holding above the 180-day SMA. That had been a pretty strong area throughout the whole year, and then all of a sudden, boom, earnings. But we ended up remounting because it was a very strong area. Like we said, if you had your stop set, slightly below the 180 day, you would have gotten way shaken out. And so that's one of the things we're going to spend a lot of time really going over. Where is the right or the best area to set your stop loss or take profit, taking into consideration the fact that the market likes to probe areas, shake people out, and then remount. There's no right answer as to that. There's no like percentage off of a moving average or off of a key support or resistance level, like say 0.25% below a moving average is where we're going to set our stop. It's all going to come down to that trade specifically.
Okay.
And really running through the risk reward behind that.
That makes sense. Now this one you would use the 180 day, not the 50 day because it's not respected, but. And then are you looking for both to be respected, or if the 180 day, so the 180 day is respected since August, July.
Okay.
Correct?
Yep.
So then all these.
So those are all tests,
It's bouncing.
Probed above the 180 day, just slightly remounted.
And so it's like, what, 3%?
So we're sitting
4%.
about 4% off the 180 day. Yep. So are you saying if you wanted to go short, you'd use that as your stop loss, or you would go long and use that as your take profit?
My question was more of the 180 day.
Yeah.
Is that enough, or are you looking for both the 180 day and 50 day?
Depends on the setup.
Okay.
So that'll make more sense in the coming video.
Okay.
Yeah. Because there's no, looking at this, I wouldn't say there's a setup here.
Okay.
It's too choppy too.
So because these spikes are.
So the 180 day is respected, but the chart is too volatile. It's too choppy. Even though it is earnings, it's still too choppy. It looks way too choppy, and it would be hard to find anything there, really. So far, we've covered, obviously, the understanding of support and resistance, which is just going to be essential in trading as a whole when it comes to many variables of our system. We've covered how I look at these trends, how I like to identify these patterns. We haven't talked too much about patterns. Maybe that's something we could dive into a little more, but we've talked about whether moving averages are respected or not, and the whole premise of essentially being able to look at a chart, be able to identify whether there is a pattern or not, and be able to identify whether there is a setup or not based off of the trend, the pattern, and the moving averages. Does that all make sense?
Yeah.
So do you know what I mean by pattern?
Yeah, like the higher highs, lower highs.
So if we want to go back to ILMN, we'll use that as an example. So the pattern here, what is the pattern?
Bearish. Going down.
Or the trend is bearish.
Lower lows.
The pattern of, pattern we could see, that's a very straightforward way of saying it, is lower lows. The pattern is also tests with rejections off of the 50 day. We can see the clear lower lows. Every time we've pushed into a new high, we formed a new low. Pushed into a new high, formed a new low. Pushed into a new high, formed a new low. Pushed into a new high, formed a new low. So what do you think my intention with this trade is? Kind of knowing everything that we just covered.
To short it, or
to short, yeah. To bet on the stock.
Is that the right terminology?
Yeah, you could say to short. We're just betting on the stock to essentially continue following the same trend. So I'm essentially looking for a pullback down to that low, $89. Okay. This is a very clear pattern that has been played out now multiple times of these clear lower lows. Every time we made a new high, we've been rejected at the 50-day SMA all the way down into that new low. So I'm looking for a continuation of this trend and of this pattern, knowing that moving averages are respected. And then you can see we've got some areas of support here.
All right.
Does that make
sense?
Okay. And this is all going to take, practice. We're going to do a lot of repetition. And don't worry, I'm going to cover all of this multiple times, many times over and over and over. I just want to make sure you're actually following along.
You've answered all my questions.
Okay.
So far.
Awesome. Before we wrap up this video, we have some homework. I have homework for Josh, and I think you guys should
follow along with me.
So the homework is going to be to go through the S&P 500. You don't need to go through all 500 stocks, a couple hundred stocks, and do exactly what we did today, was scan through, right, visually looking at each chart, and just answer the question of, are moving averages respected or not? Okay, so we're looking at the 180-day SMA, and we're looking at the 50-day SMA, and you want to just go through respected, yes, no, respected, yes, no. And just train yourself to visually be able to pick up on that, and over time, you'll get better and better and faster. But that is going to be a vital piece of actually understanding setups, which we're going to dive into next week.
Perfect.
All right. Hope you guys did enjoy this one. Again, if you are interested in joining my mentorship group. The first link will be in the description below. You can go ahead, click that link, head over to my website and apply. And with that said, we will see you guys in the next episode. Later.
Peace.
This is part 5 in the series where I'm going to be teaching my friend Josh how to become a consistently profitable trader in the stock market. And today we're actually going to be diving into my trading playbook and going over 2 of my top trading setups. Now, if you're new to the series, the link in the description below will take you over to the full playlist. You can start on episode 1 if you would like and progress with Josh up to this point. Before we hop on inside my computer, I just want to quickly mention that I do offer a mentorship group for those out there seeking guidance and wanting to learn how to become consistently profitable traders in the stock market. You'll get access to not just a curriculum of videos covering my entire trading system, essentially everything I've learned over the past 7 years in various markets, but you'll also have access to essentially see and copy my exact trades. So anytime I'm putting on a position in the market, I will post that entry. And when I go to close that position, I will post my exit, giving you the chance to essentially mirror myself and my success or failure in the market. There's a lot more included, and the first link will be in the description below if you want to go check that out and apply. All right, with that said, you ready to go?
Let's do it.
Let's get started. So my first setup, not in any order, but just how I have them inside the masterclass, is going to be the BOP, or the break of pattern. Now, I mentioned this in last week's video, but I have setups that correlate to bullish or bearish trades. Okay, so essentially whether the market's going up or down, I can still make money. So I have a bullish setup here, a bullish setup here, a bearish setup here, and a bearish setup here. So this just allows me to be able to make money no matter what direction the market is going. So whether we have a very red year or a very green year, that does not matter. I can still trade these setups. So let's jump right into the BOP, so the breakup pattern. I went and found a chart that I think presents what I call the break of pattern. So essentially what we're going to be looking for on a chart to figure out whether that chart presents a breakup pattern or not is, first, obviously, let's identify the trend. What's the trend?
Bearish, down.
Bearish trend into the all-time low at 350. But look at this. We've seen, okay, clear, obviously, lower highs, lower highs, lower highs, lower highs, lower lows, very bearish trend. That 50-day has been acting as a resistance level. We formed that all-time low at 350, but then look at recently, over the last couple of weeks, look what has happened here to this chart.
Starting to bounce back up.
So what does a breakup pattern sound like to you?
Sounds like if the stock's been going down, if it's been bearish, but then all of a sudden it starts going up.
Okay, so
right? Like over the last...
We're breaking that pattern of lower highs in this case. And it is a bullish setup, like you said, which means we're betting on that stock, the direction of that stock to go up. So for example, on DDD, obviously coming off 1109, we ended up breaking below the 180-day, and then we have this 50-day trailing overhead. We started forming clear lower lows. Again, pretend nothing has happened yet up to this point, right where we are right here. Lower highs, lower low, rejections at the 50-day, lower lows, rejections at the 50-day, slightly probed that level, right? And then retraced, lower low, push into the 50-day rejection, lower low, push into the 50-day, lower high, rejection, probe that level, broke below. You can see this pattern that's been playing out. So if we want to go ahead and just draw our resistance levels, we've definitely got some resistance here. Okay, at 499, looks like we've had 2 tests on the 4-hour, again, each candle being 4 hours. And then we've got another area of resistance, which looks like we've got 1, 2, 3, 4, 5 tests at this area, 452. So that's looking good.
That's good.
What does that mean? More tests of an area?
Means stronger resistance.
Stronger resistance. Okay, good. Same as support. And then obviously we've got a little resistance here. We can see obviously coming off that low at 350. Well, what signaled, or I guess what let us know that this chart was essentially shifting its overall direction from bearish to bullish? Because that is going to be the breakup pattern at the end of the day. What we're trying to do is identify a chart where the trend has been bearish. Okay, we've seen those lower lows, lower highs. We want to see, those moving averages being respected. And then all of a sudden, the chart has reversed and shifted, and we've broken that pattern of lower highs. We've broken above those previous resistance levels, and now we're in a bullish trend. So where on this chart does it look like we broke that pattern?
Yeah, I'd say right around
Broke
here.
that pattern and broke that trend, right?
Yeah, because
Okay.
it was no longer probing. Is there for what, week and a half?
Trading above the 50-day, you're saying?
Yeah, trading above the 50-day.
Okay, for a week and a half. And then where was
And
that?
then drop back down. So that was back in October.
Yeah, so
Late October.
Okay. And then
But fell.
we fell. Yeah, we formed a new low, or an all-time low in this case, right? And then this right here looks like where the direction shifted, coming off of that all-time low at 350, right?
So it bounced back up, broke the 50-day.
I would say the break,
and then broke the 180-day as well.
And then it broke that very strong level of resistance at 452. See, I'm looking at that level, that very strong level of resistance, 452, we broke.
Okay. I get it. So you're not looking at necessarily the
Depends
50-day.
on how respected the moving averages are. But, we started just trading, pretty much on the 50-day. I mean, there wasn't much respecting going on here. You can see we were just on top of that 50-day for quite some time. But
then here it bounced.
Let me show you.
4 times.
I'm going to paint this picture out better, and I'm going to give you a bunch of examples. Okay. So let's just do a quick summary, okay? Bearish trend, pattern, lower lows, lower highs, 50-day being respected, okay? Rejections at the 50-day, 50-day acting as resistance. Started to definitely break that pattern of lower highs as we started to no longer respect the 50-day. Ended up pulling back into that low at 350. And then as you can see, we started to push off of that low. We broke above 452. And at that point, I'd be like, all right, it looks like the trend here is starting to shift. It's starting to reverse. And then you can see we finally got a nice clear break and now have traded back and broken above 499. Okay, clear break above 499. And now we're working toward our next level of resistance at 560. And I'm not drawing a trend line or anything. I just want to just visually kind of paint the picture as to like what we're looking at here. You can see this channel. Again, this is just for an example. I don't trade based off trend lines, but you can see this kind of channel we were forming, or we were, trading in, and then we really just broke above that previous resistance, broke above the next level of previous resistance, obviously broke above the 50-day. The whole trend has shifted. We've gone from bullish to bearish. We've got that breakup pattern. And that would be what I call the BOP setup. And so in this case, if we entered, for example, now, we would play a move back up into that 560 area. Now, again, the cleaner and clearer the chart, the easier it is going to be to identify those levels, where we're going to be right, where we're going to set our take profit, and where we're going to be wrong, where we're going to set our stop loss. I would have actually, let's say this was 2 weeks ago, looked to enter as we broke above this kind of 452 area and held, and then I would have tried to play a move back up to 499, and then at this point, now that we've broken 499, looking to play a move back up to that next level of resistance. And the optimal way to trade this breakup pattern is once you get that first break, which would have been, like I said, kind of this area
the
here.
452.
Then obviously that was at this point. We did end up slightly pulling back below. Well, then playing that next move right up into resistance. So this chart's a little choppier than I'd like, right? See these giant, 4-hour candles, a little volatile. I would stay away from this one. However, that is, an example. Let's find a little better one, I guess. So like breakup patterns will be very apparent when it's been, say, a couple weeks or months as the whole market has been trading down. And then we see, a reversal within the overall market. You're going to be looking on the individual stocks themselves, knowing that we want to look at the trend pattern moving averages. And then once we get that, I guess, buy signal, which would be a break above that previous resistance, whether that is based off the candles or based off the moving average, then we're going to be playing that essentially the break of that pattern up into another area of resistance, and that'll be our margin for profit.
Okay.
Here is an example. Ticker symbol ALK, trend bearish, 50-day, definitely respected. Clear pattern of lower lows, lower highs, formed that all-time low at 30.75. And then again, let's pretend that all of this is yet to happen. Okay, so that's not there. Okay, put ourselves in the mind space of this is where we're currently trading. let's look back and identify areas of resistance. So every time we see a pullback into a push, we've got a resistance area here at 35.50. We see another pullback into a push, another area of resistance, right? Roughly at 34.84. Pullback into a push, couple tests of 33.39, pullback, and then that low at 30.75. So there's two scenarios that could happen at this point. We break this low and continue trading lower, or we bounce off this low and trade back up to this 33.39. Now, when we say theoretically, if the chart was sitting at, this area around 33.24, just below resistance, two things that are going to happen. We're either going to get rejected, bounce back down, and more than likely break that low, or we're going to break above. So on the break above this area of resistance, so 33.39, as we get that breakout, right, you can call that a breakout, that would be our buy signal, right? That's where we'd look to get in and then play the move back up to this next area of resistance, because we've all of a sudden broken this pattern. Because you can see we haven't ever broken previous highs. Like, this chart has been in a very steady, strong continuation of lower highs. Not that these previous highs or these resistance areas are going to come into consideration, but we could just say there's a high, there's a high, there's a high, very just rough, right? So the second we see the bounce off of 30.75 and we start to push up toward 33.39, well, more than likely we're going to get rejected, knowing the overall trend and the pattern here, what has continued happening, time and time again over the last 4 months.
Since July.
But what we've seen now happen, obviously here, is that we were able to break above 33.39. So we wouldn't enter here right below. We would wait for a break over resistance. That is going to give us confirmation of the breakout pattern. That is the breakout pattern setup. Then taking a position, knowing let's wait a little bit to see if we hold. Obviously hold above this resistance area, take a position, and then once, you can even see here, let's just now pretend we can see all of this. Once we did break this area at 33.39, we did end up probing below. Now that's going to come when it gets to the point where we actually go about setting our stop loss and take profit. We'll talk about where we would have set that in this case. However, look at the chart. I mean, you can see we've clearly continued trading higher. And that's why I say, like, the cleaner and the clearer the chart, the better. Maybe it would have been hard to identify where we would have been wrong on this chart, because we obviously wouldn't have entered right here at 33.50 and then set our stop loss at that area. But you could also then look at the 15-day EMA and say, hey, look, we broke above the 15-day EMA, and now let's use the 15-day EMA as a level of support. There's obviously different ways you can go about setting that trade plan, where you're right, where you're wrong. But once we did break that 33.39, that was break a pattern. We continued forming higher highs, and we can see we broke 34.84, and then we broke 35.50, and now it looks like we're working our way back up to this next area of resistance. Okay, another example. So this one's a little choppy for me. Looks like no moving averages respected. We're just looking for very clean and clear charts. Here is another example, ticker symbol AAL. Obviously, this chart is not as, I would say, as great of an example as the last one, but 50-day, obviously respected. Lower lows, lower highs, bearish trend, low at 1086. Looks like we started trading up, breaking above resistance, just two smaller resistance areas. Higher highs, two higher highs after forming lower lows, and then another high. Obviously, we've got this resistance at 1275, roughly. Looks like we were rejected and then ended up pulling back. Now the 50-day went from acting as a resistance area to acting as a support area. You can see the difference here. Now we have test of the 50-day acting as a support level. One, two tests of that. Obviously, rejections at 1275. At this point, I would say if we ended up trading back up to 1275, breaking above this area, we could look to play a move back up to 1301, because at that point it looks like the trend definitely would have been reversed, and we're just waiting for a break of this pattern, a break of this previous high at 1275. But not a great chart. I probably wouldn't take a trade on that one. All right, I'm going to pull up an example. So this example is from the trade ideas section with inside the mentorship group. Essentially, I know this is a bit blurry, but we can see MDT, okay, coming off that low at 68.84. Essentially just looking to break back above 73.94. And then the next clear level of resistance being 76.56. Do you think at this point you're starting to get a good understanding of the breakup pattern? Mm-hmm. Essentially, we just want to see a shift in trend, a change in the direction of a stock. And then once we break that pattern, we're entering and playing a move up to that resistance area. It's pretty straightforward.
Mm-hmm. It seems straightforward.
All right, I'm going to have Josh go through a couple charts, try to identify. Let's see if you can find like 2 or 3 breakup patterns.
It's not really supported though, right?
Too choppy.
Yeah. Well, right here, like before, say if we're...
Okay, here's one. Yeah, DG. All right, so it looks like we came off that low at 101.09. You can see we broke above the 180-day. Definitely broke back above the 50-day. Looks like the direction did totally shift. Kind of keeping an eye on our next level of resistance at 128.69. What would happen if we broke above 128.69? What's our next area of resistance overhead? Looks like a little resistance there at 133.88 and then 139.11. So the idea of figuring out where that resistance overhead is to give us a picture as to when we go to set up that trade plan, where's our take profit going to be set? I don't want to see a lot of tests of a resistance overhead if we're, trying to bet on the direction of that stock going up, right? The less tests of a resistance area, the better. But we want to know where is there going to be resistance that this chart is going to run into.
Yeah.
And then we could see if we want to get out there or not. So, say 133, that 80, 133.80 area roughly.
Yeah, because if there's not a lot of resistance, then
That's
ideally
good.
it keeps going up.
Exactly, yeah. And then 122, 42, we were just using this as an example. We did break that area of resistance.
Later.
There you go. Look at that one. It's a little choppier, but let's identify our levels of resistance above where we're currently trading.
That's pretty high up, though.
Yeah, that's pretty high up, right? You probably won't ever be looking to take any trade up in that area.
Okay, so this is our low.
Yeah, if you kind of want to work your way, down.
Over.
It's easier, yeah. Just very rough. Obviously, we're going to be more accurate if we actually go to take a trade on one of these charts, but just for practice, kind of draw out that general, might be a couple cents off of the general resistance area with our trend line.
Like that's not really anything, right?
I mean, there'll definitely be a little area of resistance there.
Yeah, that's kind of like where it's playing right now.
And again, the same concept of the market will probe levels and then break back below. I guess the better way of saying is the market will probe a key level, a support or resistance level, whether that is based off of candlesticks or based off of the moving averages, and then probe that area and then retrace or remount, right?
So you'd be looking to enter.
What would you say, a break above 52.98? Wait for a break above 52.98. Once we get that break, see if we hold that area. If it looks like we're starting to hold that area, or if it looks like we're starting to work our way up to 53.63, then we can take an entry and play.
Because then it'll broken both of these and the 180 day, correct?
Right. We got the 100. Well, is it 180 day respected? And you want to look at the whole picture here. We haven't tested it at all, so I wouldn't even
look at that.
I mean, they're just know that inherently it is the 180 day. It will be acted as a level of resistance, but there's 0 tests of that level. So how strong of a resistance, we don't know.
Okay.
Then you kind of have to look at the margin for profit. Are you saying you'd play the move from essentially 53 to 53.63?
Yeah, but is that like enough of like a percentage for you to do that?
So here's kind of like a rule of thumb for me. I guess I use this rule of thumb to determine whether the trade is even going to be worth looking into further. So I look for a 3 to 5% margin for profit within the chart. So from where we're currently trading to that next area of, again, support or resistance, is there a 3 to 5% margin? So what's our margin here?
It's like 1.
So more than likely, a 1. Well, I would even say I would wait for a break above 52.98. right? I would
Yeah, because it's kind of trending.
We want to see a break of that pattern. So it looks like we haven't broken this area yet. And we've been, bouncing off that kind of resistance area. So I would wait for a breakout, a break of that pattern.
Yeah, and then maybe look for how strong? Look for something around the 55, 51.
Yeah.
After you break above the 53.
Yeah, and I think keep in mind the longer you start trying to see a trade there, more than likely there's just not a trade.
So you're saying ideally you would just see
it would
if
be
it's
very
obvious
apparent to you.
it's the best.
If it's obvious, it's the best, and if it's
if you're searching for it,
yeah,
it's not worth it.
Yeah, exactly. Let's find one more example of the breakup pattern. And the breakup pattern, I've only traded, I think, once this year. I've taken one trade, I'm not kidding, on a chart that presents a breakup pattern. Last year, I took way more. It's one of those setups this year that I just haven't traded. But it still should be in your playbook. Now, this is going to be part of your homework. I'm going to have you go through as many charts as you possibly can, and not only try to identify charts that present the breakup pattern setup, but also the other 3 setups that we're going to get to.
Okay.
All right.
So is this a chart you would even look at?
Okay. Let's see.
It's respected
the 50.
A number of times.
There's no, you don't even really count it. You could just see, how long and how many times have we tested? We've tested, many times, one very clear test, or really 2. There's another one, 1, 2, 3, 4, 5. That could be 10 tests right there, multiple rejections. And it's been how many months since we've been below? Well, August. That was August, so 3-4 months. And that's really going to validate that very strong trend. Now you can see we're coming off that low at 21.91. And all of a sudden we break that 50-day and we start holding above it. All right, and then it tries to, pull back. But now we could see the 50 days acting as a support level. So when it comes to moving averages, in this case, what was once resistance has now flipped, and now that moving average is acting as a support level. And now you can see we've broken these highs, previous highs, some smaller areas of resistance. Now we can just look for a clean breakout of kind of this area, I'd say, and play that back up into 25.96. So yeah, if we essentially see a break above that high, we would really like to see a break. We've already seen a break above 25.01. Now we're kind of choppy in this area, trading in a bit of a range, kind of working our way to the downside. 180 days right there. Let's keep in mind. I would like to see a nice break above the 180 day and outside of this kind of chop. So realistically, 25.34. We want to be clear out of this area to then play a move to 25.96. It is too choppy, I'd say right now, just because we have been kind of trading in a range for the last week or so and not really making much ground to the upside, I would stay away from this one.
Okay.
So you have to be really extremely picky. And that's why, some days I just won't take a trade because there's just nothing. I can't, even within the 4 setups that I trade, I can't identify anything. Or one chart is very close, to being at the point where I want to enter. So at this point, I feel like you have a pretty good understanding of the breakup pattern setup. Do you want a checklist as far as what we're looking for?
Yeah.
You think that would be helpful?
That would be helpful.
You guys should be taking notes alongside Josh because I know there's a lot that we're covering, a lot we're going over. And so just don't get overwhelmed and definitely watch this multiple times if you have to. Number 1 is going to be the trend. That's the first box, I guess I'd say you have to check. So
downward trend, bearish.
You're looking for a bearish trend. The idea behind the setup is that the trend is shifting from bearish to bullish. So we look at the overall trend. I would say the next box is just moving averages. And you've seen in most cases it's the 50-day, but either the 50 or the 180-day SMA respected.
Break above.
That's the thing. So if you're looking at this chart, and I think this is not a good example because the intention here would be, I'm short, but if let's say I'm totally wrong, I was looking to play a breakup pattern. I would wait until we broke above, in this case, this area of resistance at 98.86, the 50-day, and this previous resistance around 102.40, right? Once we broke all of those areas of resistance, I'd look to play and move back up to this next clear resistance.
Okay.
Let's find, an example of a breakup pattern. So in this case, I think we would use the 180-day as a sign of a breakup pattern plus a previous resistance area. So it looks like that resistance level has been broken. This resistance level is sitting above head, and then this resistance level. So I'd like to see a break above the 180 day and a break above 1,000, 1,132.53, and then play that move back up to 1,213. Does that make sense? So as far as a checklist, I guess what you're looking to check off to be able to take that trade is, I guess the first thing is finding a clean and clear chart. That's like step one is a clean and clear chart. More than likely we'll be coming off that all-time low. We want to see that moving averages are being respected, either the 50 or the 180 day SMA. And then, some of the setups are more set in stone than others. This one, you don't necessarily need everything to line up, be able to check every single box off. And we haven't even gotten into risk management, where you're then going to realize, like, even though this setup looks great and these levels are very clear and I know exactly where I'm going to get in and get out, the risk reward is not there. Like, the risk reward isn't even worth me taking this trade because of whatever the reason may be, right? That's why the most important thing in the beginning is to understand, like, how to, look at a chart and do your TA. So again, trend good, bearish to bullish is the idea. We're looking to see a break of that pattern of lower highs. So we want to chart out those lower highs essentially. So charting out those resistance levels.
Okay.
And then as we break out of that resistance level, we're looking for that break of pattern, wherever you define that pattern to be broken, essentially. So whether you're defining that pattern to be broken at the 50 day, whether you're defining that pattern to be broken at a key level or area of resistance when it comes to the candles, more than likely the case is when I've traded this, I'm looking for both a break above a moving average, more than likely the 50 day, and then a break above a strong level of previous resistance. Once we get that breakout, then we've, obviously got that confirmation to enter, that signal that we've broken this pattern of lower highs, we've broken this bearish trend, and now we're shifting to, a bullish trend.
Okay.
And then we're going to play that move back up to that next high, wherever that may be, that next area of resistance, and then using an area of support below as our stop loss. So this setup specifically sometimes can be harder to find that area where you're going to be wrong, where you're going to set your stop loss, but it's normally very clear where you're going to set your take profit, because it'll be at that next clear area of resistance, which again, you preferably want less tests of.
Yeah.
Let's see. So what do you have?
Okay, so we have bearish trend to bullish. So that's like that reverse of the bearish trend.
Yeah, I mean, in a way, like, this is a reversal as well.
And then just clean, clear chart. Moving averages are respected in the past, and then also charting out the resistance levels. And then finding a less respected resistance level for your TP.
Finding that next level of resistance for your take profit.
Okay.
So the next level, your take profit is going to be identified at that next area of resistance overhead. And then your support, we're going to set your stop loss at support. And when we get into trading these setups, we'll get into the trade management and actually doing so, but just generally know that your stop loss is set at support. Okay, so that is going to cover the breakup pattern. I feel like that's everything you need to know right now, and now it's really just going to be rinse, repeat, and continue practicing this setup. All right, so now that we have covered one of my bullish setups, the breakup pattern, we're going to go ahead and cover one of the bearish setups, specifically my pullback play setup with inside my playbook. Now, my playbook being these 4 setups that I'm currently trading. Now, because this would be a 3-hour video if we did go about covering all 4 setups, we decided just to give you 2 setups, a bullish and a bearish setup. So no matter what the market condition is like, you'll still be able to trade and do well. Josh is actually going to take the master class. He's going to watch the other 2 videos covering the ATL, or the all-time low bounce, so the ATL bounce, and the ATH all-time high pullback. So the ATH pullback, you're going to take those this week on your own. This is inside my mentorship group, this master class with my entire curriculum for my students. Again, if you guys are interested in my mentorship group, the first link will be in the description below. So you'll have access to this entire curriculum. Sweet. Let's pull up some examples of a pullback play and talk about what this pullback play setup actually is. All right. Now, this is actually the current trade that I'm in right now on ticker symbol we're back on ILMN. So what we're looking for when it comes to the pullback play is, and this is very almost similar, and you mentioned this while we weren't recording, but this is similar to the breakup pattern. It's kind of like the opposite of a breakup pattern. So we're looking to find a chart that presents a bearish trend. Okay, we're looking for either the 180-day or the 50-day SMA to be respected. If not both, then one of those moving averages And then we're looking for that pattern of lower highs and lower lows. We're looking for a recent low on the 4 hours, so that all-time low to just have been formed. So within the last couple of weeks, we're looking for that all-time low. You can see at 89 in this case to have been formed on whatever chart we're going to be looking at. So the intention is to continue playing the overall direction, playing this trend, playing this pattern that has developed. Okay. For example, you can see we pulled back. Okay. Formed a lower low, pushed, rejected in this case at the 50-day SMA. Lower high, pulled back, lower low, pushed, lower high, rejected at the 50-day. We're looking to just continue playing this pattern, considering the overall trend. We're playing the direction of the trend. You know what playing the direction of a trend means versus like playing against the direction of a trend?
Like hoping it continues along the same way. Like, so if it's resisting and it bounces down, then when it goes to, I don't know.
So the trend, say it's a bullish trend.
Yeah.
Think about it like this. Okay, so in this case, ILMN, the overall direction is bearish and we are buying puts. The setup is to short a bearish chart. It's not going long on a bearish chart.
Okay. That would be a breaker pattern. No. Don't say that.
The idea with, that's okay. The idea with the breaker pattern is that we're identifying a break of that bearish pattern into a bullish pattern, and then we are playing the new trend, which is bullish, which means we're betting on the stock to go up.
Okay.
Does that make sense?
Yeah.
So that is the difference between playing or trading the direction of the trend, trading with the trend, or trading against the trend. Because trading against the trend would mean that we get in this stock, for example, same stock we're looking at right now. Playing against the trend here would just be betting on the direction of the stock to go up before we get any confirmation of a reversal. Okay, before we get that breakup. Does that make sense?
Yeah.
So, you know, we're looking again for all these kind of boxes to be checked. We're identifying resistance overhead, which is where we're going to set our stop loss. With this pullback play setup, we're looking for a pullback down to that all-time low. Okay. Again, the cleaner and the clearer the chart, easier it's going to be to identify these levels, where we're going to be right, when we're going to be wrong. So yeah, the intention here, just knowing that we've got some resistance overhead in this 98.86 area. Okay. Looking at the candles, we obviously have the 50-day SMA, which has been trailing, obviously acting as resistance, several tests. And then we're looking for a pullback down to that low at 89, just keeping an eye on, obviously, the support level here at 92.27. So stop loss, okay, is set here at 98.86. I'm in this trade right now. And then we've got resistance overhead at the 50-day. And then my take profit is at 89, okay? Keeping an eye on that support below. I'll actually give you some examples of trades I've actually taken so far this year over inside the mentorship group. All right, so here's an example of a pullback play. Okay, I shorted ticker symbol DG. Now I know this is a little small, but this is just a screenshot. Tell me, what do you see here? You gotta get really close.
Let me look. Okay, so hit the 107. Is this where you bought in?
So this screenshot is when I entered. So this was like the time of entry right now.
Okay, so you entered right there.
I entered right here, yeah.
So right when it's about to hit the 50-day.
Yep.
Correct?
Yep, right here.
And then you'll take profit down at the 101.69.
Yep. Okay, so
And
looking
your
at...
stop loss is at the 107.89?
Yep, exactly.
Sorry, I don't know if you can hear me in this mic. I was talking over here. But
No, you're good. You're good. So you can see, obviously, overall trend, bearish, right? Lower lows, lower highs, 50-day. Okay, acting as a level of resistance. We obviously had a lot of chop back here, but looking at the immediate trend, we can see that, you know, we have been trading below the 50-day. We have been trading below the 15-day. And then, you know, we did break back above the 15-day. As I said, 15-day is probably the last moving average that I'll ever use when it comes to my trading. But occasionally I will use the 15-day as, like I said, a trade management moving average. Really what I was looking at here was the overall trend, obviously, you know, just the direction, the clear pattern of lower highs, lower lows, obviously taking into consideration the 50-day being overhead, rejections at the 50-day, 1, 2, 3 rejections. And then you can see that all-time low we just formed the day, you know, before I entered this position at 101.69, like you said. And then you can see that resistance level at overhead at 107.89. I would say 2 to 3 tests, definitely a area of resistance that I could identify. That was the next clear area of resistance overhead, right? And then we got the 50-day as well. So I kind of explained that. Obviously, I ended up buying that position. I got in that position, posted the broker fill right there. And then you could see this was 2 days later. I ended up getting out of this position for, like I said, 15.43%. That was obviously the percentage that I was shooting for as far as the profit. So profit target was 15%. I made 15.43%. And then you can see the chart obviously playing out exactly as we predicted. You could see we just pulled back down right into that low at 101.69. If I look on the 1 minute, look at that. 101.69, 101.71, boom. I hit that right there. And then I got out of that position. And then there's the broker fill. Great example of a pullback play. I think I'm at around 85% or 81.25% on this pullback play setup right now. So let's see if we can find another example here.
2,000 years later.
Looks like you found one, a pullback play on ticker symbol SMC. Break this down. Let's zoom out. I want a little breakdown from you. Ooh, it looks good. I like it.
Back in July? Resistance, resistance, resistance. And it was following the 15-day as well.
Yeah, 15 days come into play a couple times.
And then there's a little bit of, what do you call that when it breaks through?
Just where the market like probes the level.
Yeah, that's the word I was looking for.
Yep.
Probed again right here, and then but it was right along the 50-day. So if you're down by 49.49, and then we're trading at probably like right there. So you take your
That's a safe bet.
stop loss.
Yeah, obviously there's more than likely, just to, give you a sense, go to drawings and we can kind of chart out the margin for profit and the area to your stop loss. And again, 3 to 5% is kind of a rule of thumb. So there you go, 5%, 7%. So just knowing the risk to reward behind this trade might not be great.
Right? Yeah, because there's the percentage is more,
downside presented on the chart. But otherwise, it's kind of hard to identify a clear level at which you'd get out, at which you'd be like, all right, I'm definitely wrong here. Just looking at, the very kind of tight range, you could see there wasn't much movement, probably an average of 0.20% covered within the day there. So you just got to keep that in mind. If a stock's only moving 0.5% versus when a stock's moving 5% in a day on average, that's obviously going to have to come into account into your trade plan, right? And just setting realistic targets. Let's put it this way. If you look at a chart and you see the average daily movement on a stock is 0.5%, yet you've set your take profit or stop loss 10% above or below, right? Where you're currently trading, and your average hold period is 3 to 5 days. So from when you get into when you get out of the trade, it's 3 to 5 days. Then that's setting an unrealistic target, right? Because that stock might not have moved 10% within 4 months. So why do you think that stock's going to move, 10% in 3 to 5 days? So a lot of setting up your trade plan comes down to just setting those realistic targets. It really does. This chart definitely does present a pullback play setup. However, the margin for profit just might not be there. And that stuff we'll get into later on in the series. Let's find like one more example of a pullback play. And then I'm going to have you dive into the masterclass and go over the next 2 setups on your own in this next week.
All right.
Let's do it. You found one?
I think so. So BMI.
Okay.
Or BMY. Resistance. Resistance.
Yep.
Broke through a little bit there, though.
It did. I would say the 50-day is not acting as a resistance area. Obviously, the 180-day is definitely, but it's trading so far above where we currently are right now that it's definitely not an area where you'd set your stop loss. However, I do definitely see this pattern of lower highs, lower lows continuing to play out. And I definitely think we could see a move back down to that low at 48.12. If you want to zoom in, go about setting your obviously support level there at that all-time low. And then I want you to set where you think you'd go about setting your stop loss.
Take profit, 48.12.
Okay.
Right there. Stop loss with the resistance at 49.88.
I like that. And that lines up with the 50-day, which is good. But just know the 50-day is trailing, like it's a moving average, so it won't stay there, unlike, obviously, the candlesticks. So I like that. What's your margin for profit? And then how far are we from your stop loss? And that'll kind of give you a sense if you want to like look into the trade further.
Only like 1.6% and then 1.9%.
Okay. All right. Well, I think still I would look into this and see, when it comes to simulating out this position, figuring out what the risk reward would be. We're still a couple weeks out from that, but not bad.
All right.
Okay, so your homework is essentially go back over both of the setups that we covered today, right? The breakup pattern and the pullback play. I want you to go through many more charts, as many as you can. Again, the more practice, you're just going to build up that confidence. This will become very second nature. You'll become very fast at, looking at a chart, being able to identify these setups. I want you to watch the other 2 videos in the master class and go over the ATL bounce and the ATH pullback. So those are 2 of my setups that I've done very well on this year. When we meet next time, you'll have a pretty good foundation. And then we can really progress on to the next part of this process. Does that sound good?
Sounds like a plan.
All right.
Let's get it.
Awesome. All right. Again, if you guys are interested in learning how to become a consistently profitable trader, I did put together a mentorship group. All of the information covering what is included in my mentorship group is over on my website. So all you have to do is click the first link in the description below and check that out and apply if you are interested. So hope you guys are enjoying this series so far. Don't forget to subscribe, smash that like button, and drop a comment if you have any questions. Anyway, with that said, we will see you guys all in next week's video. Later.
Today, I'm going to be learning how to trade options.
That's right. This is part 6 in the series where I'm helping Josh become a consistently profitable trader. We're going to be hopping on inside my computer and covering everything you need to know when it comes to options trading in the stock market. There will be a link in the description below for those of you who are looking to start on episode 1 in the series and follow Josh up to this point. Now, real quick, before we get started, I did want to briefly mention that Josh does have access to my mentorship group.
Correct. I will be going back every day throughout the week and just reviewing what I've learned throughout the days of him mentoring me in person.
So essentially everything I'm teaching you, it's already put together in a formatted curriculum, A through Z, covering my entire trading system. Essentially everything I've learned over the last 7 years in various markets. If you'd like access to my mentorship group, the link in the description below will take you over to my website where you can see everything that is included. With that said, are you ready to learn how to trade options?
Let's go.
All right, so do you have any idea what options are?
Yeah, a little bit. It's essentially like leveraging a share of a stock, right?
In a way. Okay, so have you heard of an option contract?
Yes, briefly, like a little bit.
Okay, so
run me through it though.
Okay, one option contract is going to give you the right to essentially buy 100 shares of that stock at a certain price. Essentially leveraging your money 100 to 1, like you said, where, for example, if you had $200 in your account and that is all you have to trade with, say Microsoft is trading at $200 a share, you can buy 1 share of Microsoft. Whereas if you buy an option contract on Microsoft, that contract, say, is worth theoretically $200. Well, all of a sudden now, instead of having $200 in essentially buying power, you have 20,000.
Okay.
So you leverage that capital you have in your account. So options are great for most people because I would say on average, anyone, getting into the market has between $500 to $1,000 to start with. So all of a sudden, now you can really see substantial and worthwhile gains that otherwise, just trading, shares of a stock, where you're not only limited just to, betting on the direction of a stock to go up, just buying the share and holding the share, right? Mm-hmm. You buy $1,000 worth of 1 share and it goes up 1%. You can see how you're not going to make much money. Whereas you buy 1 option contract that's worth $1,000 and it goes up 1%. Now you have all this leverage, or if the stock goes up 1%, right? Not the contract, but.
Yes, this is a way to also make money in like a bearish market.
Okay, so exactly. In options, there are what is called a call and a put.
Okay.
So do you know what a call or a put is?
A call's betting on it going up, the stock going up essentially, and then a put's betting on it going down.
Yeah, so call, you're betting on the stock to go up. Put, you're betting on the stock to go down. So now you have the flexibility to trade in various market conditions, to trade any stock, no matter where the stock is headed, right? Obviously, as traders, our job is to, with our best knowledge and all of our resources, try to decide where we think a stock is going to go. So if we have a bias behind us, any stock, say Microsoft, and we think Microsoft is going to go down, then we'd go about buying puts. So today we're going to hop onto Thinkorswim. That is the platform that we're using. And I'm going to show you how to go about actually buying those options. We're going to cover what are called the Greeks behind an option, kind of, very basic option terms, and really just make sure that you have an understanding as to this vehicle that we're going to be using moving forward in this series to invest and, take our money and hopefully turn it into exponentially more, right? That's the goal here. So let's hop on inside Thinkorswim. If you're under the trade section, obviously this is where you can see your chart. You're going to want to head over to all products. Give me a stock.
Uber.
All right, so if I go to trade all products and I am looking at ticker symbol UBER, well, we can see here that we have what is called the options chain. Under the options chain, we have these dates: December 1st, December 8th, December 15th, December 22nd, December 29th, etc., all the way up to, January 16th, 2026.
Okay.
So within this options chain, these are what are called expiration dates. So when it comes to buying an option contract, the first thing to do is you have to identify the expiration date behind the contracts, because when you buy this contract, it expires. The contract actually has a lifetime. Does that make sense?
Yeah, so you can't just hold on to it forever.
No, it's going to expire eventually. So for the example, let's look at the March 15 contracts. So after you hit this drop down, now you can see we're presented with a bunch of data. Now, this is kind of overwhelming. So what I look at here is if we go to customize, and by the way, if you're on any other platform, you'll be able to see all this same information. Okay, it'll just maybe be displayed in a different way. I'm looking at the volume, the open interest, and theta. Now, that is all I look at in my trading, and I'll explain why that's all I need to look at. Okay, so first off, the expiration date. So we're looking at the March 15th contracts. Over here, we've got the strike price. Do you know
What is a strike price?
The common misconception when it comes to options is, say someone decides they want to trade Uber and they think that, they're betting on Uber to go up, and they are going to say, hey, I think that Uber is going to be at $60 in the next month. So they'll buy the $60, strike price. And then on the left here, we've got calls, and on the right, we've got puts. So the strike is essentially the value of the stock, right? So right now, Uber is trading at 56.43. These are going to be the $60 calls. So essentially, if you bought the $60 calls and you held those $60 calls all the way until March 15th, what would happen was that those contracts will expire worthless if the price of Uber is not at or above $60. They will have no value at all. Zero value.
Will they have value if it's above $60?
Yes.
Go on.
But here's the thing. The other common misconception when it comes to options, I'm trying to explain this in the most straightforward way because it confuses many people, is that there's no time you have to sell the contract. You don't have to hold contracts through expiration. Most people think you have to hold contracts through expiration. Whereas, I might buy a contract today and sell it tomorrow. When it comes to actually figuring out what the right contract is to buy, that's all going to boil down to how much you're going to make and lose on those contracts according to your trade plan.
Okay.
And your risk reward and your risk management as a whole. And we'll get to that. But what you need to know is essentially, these are the strike prices. And when you look at either the calls on the left or the puts on the right, well, we can see contracts, Each row is a contract shaded in blue. And then we've got these darker contracts, and same on the other side, right? Shaded in blue, and then these darker contracts. So with calls, these contracts that are shaded in blue, these are called in-the-money contracts.
Okay.
Do you get why they're called in-the-money contracts?
I don't.
Okay, because
I remember you saying this in the first video that we did.
Yeah.
But I completely forgot. I have no idea what it means.
No, that's all right. So essentially, if we look at the price that Uber is currently trading at, which is $56.45, and these are calls, anything below 56.45 when it comes to the strike, right? Any strike below 56.45 is going to be in the money. Makes sense?
Okay. So you're already clear, pretty much. Like when you're buying it, you're already above what you're. I'm trying to explain this. Okay. So when you buy it, right? If it expires on March 15th, and it's at 56, and then you buy the 52.5 share, you're already cleared for that 52.5 essentially, because it's like a safer option.
Okay. Not cleared isn't the right word, but they are safer. So in the money contracts are safer. So blue is in the money. Okay. that's for calls. So in the money for calls is any strike price below where we're currently trading. And then it's the opposite for puts because you're betting on the stock to go down. So in the money is any price above where we're currently trading. Does that make sense? So essentially there's more what is called intrinsic value on the in the money contracts because you bought these March 15 contracts and you bought the $50 calls. Obviously Uber is already trading at or above $50. So there is more inherent value in those contracts because you're not, essentially saying, hey, I'm betting on the price to be at this point at this date. It's already there. So they're safer. They hold more value. They hold more, what is called, like I said, intrinsic value. And then on the other hand, out of the money, these contracts have extrinsic value.
So
okay.
I'd assume that they're riskier.
They're riskier.
But the potential gain is higher.
The potential gain is higher, right? So in the money, safer. Out of the money, riskier. Okay. So these hold more value, more intrinsic value. These have extrinsic value. So they have more potential essentially to grow in price more per contract. And then the opposite goes for puts. So in the money, okay, more intrinsic value, out of the money, more extrinsic value. So what you want to take away here is that obviously these are going to be safer. These are going to be riskier. Okay, these are the strike prices. And now when it comes to the volume, the open interest, theta, bid, and the ask, we'll cover what those mean. So there are what are called Greeks. Now there are 4 Greeks: theta, gamma, delta, beta, I think. Because I used to remember all of these.
Okay.
And I used to know how to do the math manually behind all of these. So essentially knowing exactly based off of all the Greeks, delta, gamma, theta, vega, right? And if we put them there, you can see them, delta, gamma, theta, vega. I used to know how to do all the math behind it. So say delta is every time Uber, say in this case, Uber moves up $1, well, these contracts are going to gain $62 in value. Now, this is something we have to cover. See how these contracts value are displayed as 5.60? That's not $5.60. That's $560.
Because it's 100 to 1.
Yeah, because it's 100 to 1,
Okay.
right? You don't need to know delta. You don't need to know gamma. Theta, you don't really need to know either, or vega, because you'll learn how to essentially simulate out the position and the contracts, the value at which they'll be worth at, the point where you're right, where you're going to take profit on a chart, or where you're going to be wrong, where you're going to stop out. We're going to be able to see exactly what those contracts are going to be worth, right? The gain or the loss. So just generally know that theta out of the 4 Greeks is going to be the one that, if any of them, you should be aware of.
Okay.
Because theta is decay over time. Now, the closer we get to an expiration date, the more expensive it becomes to hold a contract. So it's like pay to play, essentially.
Okay.
If we bought the December 1st contracts, theta is going to be significantly more expensive than, say, buying November 15th, 2024 contracts.
Okay, that was a question I had.
And theta, right here, you could see per contract, it is going to cost you $2 a day to hold these contracts, depending on which ones you buy, right? So let's say we bought these $60 calls. Well, it's going to cost you $2 per day to hold these. And then if we look at, say, the $60 calls, but as far as expiration, we're looking at the December 8th expiration. So $60 strike.
$5
Now you can
a
see
day.
theta is $5 a day.
Okay.
So, and then as we get closer to that expiration date, theta will become increasingly more. Again, all that math we can simulate out, and that'll all be done for us with these tools we're going to, use in the future, but it's just good to be aware of theta, okay? So, like I said, we can go ahead and reapply what I was looking at before. So we're just going to go ahead and remove these, add in volume. So we're going to look at the volume. Okay, this is going to be very important. We're going to look at the open interest, and then we're going to look at the theta if we want. All right, so we've got volume, open interest, theta, bid, and ask. So the volume, do you know what volume is behind a contract? Now, this is contracts, shares, any essentially vehicle that you're going to use to invest.
Like how many people are interacting with the stock or like buying it or trading it?
Okay, so one means that, in this case, one contract has been exchanged between a buyer and a seller. Essentially, every time you see one more volume, that means a contract has exchanged hands.
One full transaction.
One full transaction.
Okay.
Yes. For example, let's say the March 15th, $55 strike. Okay, these are the calls, obviously. We've got the volume being 215. That means 215 contracts have exchanged hands today. Okay.
Okay.
And then you know what the open interest is?
No.
That's how many people are currently holding open contracts. So how many contracts right now are open?
So somebody's just holding on to it. Hasn't been
Could be multiple
no complete
people.
transaction.
Yeah. So this exactly. So we've got essentially a bunch of people holding these $55 calls, 3,469 of them to be exact. That could be 50 people, could be 3,469 people, could be one person. We don't know. And so something I'll mention now is that in the future, when it comes to actually choosing what contracts we're going to buy, we want to be aware of the volume, not just the volume, but the open interest. But the volume is going to tell us if there's no volume, it says NA, and that means there's no one trading those contracts. We want to stay away from contracts with no volume. This will make sense why when I explain what the bid and the ask are. Okay. So the bid is essentially what buyers are willing to pay. And the ask is, well, what the seller is willing to sell their contract for, right? This is a marketplace. So the difference between the bid and the ask is going to be the spread. If we want to go about buying a contract, we're just going to click on buy. One important thing to note is you never want to sell a contract. Okay. When you sell a contract, you open up essentially unlimited potential for loss. Just kind of a rule of thumb, just know to never sell a contract. Now, there are a lot of different option strategies that could involve selling a contract, but obviously covering. So you're not opening up yourself or your portfolio for unlimited downside, unlimited loss exposure or risk, right? I'm only ever trading naked calls or naked puts. That means just buying the outright call or the outright put. So I'm either buying a call or I'm buying a put, okay? So say we want to buy these $60 calls. Click on buy, and now this is going to be the spread in between 320 and 325, right? We talked about the bid and the ask. So essentially, if you want to guarantee a fill, you know the difference between a market and a limit order?
No.
Okay, so a market order, if we go here, a market order is essentially just going to fill you at any price. It'll fill you at the price that you're essentially not going to have any bargaining power. You obviously, when buying a contract, want to get the contract for the lowest price possible.
Okay. That makes sense.
But someone might not want to sell it to you for that price.
Okay.
They might want a little more. So if you want to get into a position, you go with a market order and you'll just get in at the price that anyone's willing to sell to you at, which is more than likely not going to be great. So when I enter a trade, I'm always going with a limit order and I'm always trying to get filled on the lowest end of what is called the spread.
Okay.
So this is the difference between $5, right? If I buy one contract, let's say, and I confirm and send, I'm going to either get filled or not. Okay, I might not get filled at 320. There's more chance that I'm going to get filled at 325, but let's just say I'd rather take the chance of not getting filled. And look at, you can see the spread just change and get filled at 320. So now we've got buyers and sellers interacting, right? We've got people out there trading these contracts. So the spread is going to continue to change. And right now, 325, 325. So you can see how it's constantly changing. So I can send this limit order in and say, I want to get filled at 320, or, you know, I want to get filled at 325. But again, I want to get the best price, the lowest price, right? I don't want to overpay for these contracts. And so you'll see when there's low volume, this kind of comes back to what I was saying, when there's very low volume or no volume at all, no one buying and selling these contracts, there's going to be a huge spread, a massive spread. And it might cost you 10% just to get into the trade. 10% worth of the total position because of where you end up getting filled just to get in.
That makes sense. So more volume, easier to get filled.
Yeah, it's easier to get filled with more volume. There's going to be
at the price that you want.
At the price that you want, there's going to be a, you know, the spread isn't going to be as large. So a $5 spread or a $10 spread, right, is normal. That's normal. But if you see like, okay, the mid is $3, $300, right? And the nat, okay, is going to be $500. That's a massive spread.
Yeah, it's huge, yeah.
And so you're going to be taking whatever 30, 40% loss just to get into the position.
Not what you want.
Not what you want. So you have to be careful. And then you might get into the position, but you might never be able to get out of the position. Yeah. So, you know, that's a beginner error and mistake that a lot of people run into, is the volume is very important. You got to really pay attention to that. And obviously the open interest, you know, you can see if there's no open interest, no one is out there holding these contracts. No one's going to be selling to you. You don't want to buy from.
Yeah.
Very rarely that's the case, but you got to be careful. When you go to buy a contract, obviously you're just buying a single contract, right? A naked call. We're buying, not selling, right? And then the amount you want to buy. So 1, 2, 500, whatever it may be. Position effect is just going to be auto. Obviously, we've got the symbol of the stock and then the expiration date. So the March 15, 2024 contracts. And then the strike is going to be $60. Obviously, we're buying calls, price, and you can also adjust it on here. But see, we can even go back to like $3. Say we want to get filled at $3. We'll send that through. Even though we're nowhere near right now, well, you'll see that order will end up going through. If I do it right now, confirm, send, active trader, we can see now I have my limit order in here to buy if the stock, and it gives you a rough estimate, if candles pull back to this area, right, where that green line is, well, then I'm going to get filled on my one contract. So that's a limit order. So my orders are sitting there in the order book. Whereas if I hit market order, well, I would have been filled instantly.
Yeah.
Make sense?
Yeah.
So it's pretty easy. Just buy, okay, or buy. So whether it's a call or put, and then I like getting filled, obviously, on the lower end, getting the best deal possible.
That cleared up a lot.
Okay.
I didn't know, like...
People get so overwhelmed, like I said, with options, and it's really...
Especially, like, looking at this...
It looks like a lot. I get that.
Compared to, like, when we did it on Robinhood, it's kind of just, like... It's way simpler.
It's way simpler, yeah. So...
This clears up a lot.
Yeah. So again, honestly, you don't need theta if you don't want to look at theta, but it's good to be aware of. But again, that will all be factored in when we actually do go about simulating the position before we enter, when we go about creating our trade plan. But just the volume and the open interest is what you have to be aware of. You know what a strike is now. And I guess to summarize, like when it comes to, well, how do I know what are the right contracts to buy? All going to boil down to the risk to reward, your risk management. Okay. So like I said, I don't want to repeat myself, but you'll see that the further you go, okay, the further out the expiration, the safer those contracts are going to be. And the further in the money, the safer those contracts are going to be. Depending on the position in your trade plan, where you have your SL and TP set, you might want to go out with the January 2025 contracts and buy very deep into the money. And that'll give you that time to let that move happen on the chart. Whereas if you're looking at more of a short-term trade, and especially guys that day trade, they're going to be buying like normally not same day expiration, but like the next week or the same week. So when it comes to swing trading, I'm never going to be buying contracts no less than 2 weeks out. Like this year, I've been buying way far out contracts because I'm giving myself more time. But let's say, just in general, because we're going to be swing trading, we're going to be buying contracts no less than 2 weeks out. And typically we're going to be buying about 2 to 3 months out as far as expiration. Okay.
And that makes it less expensive by the day as well, correct?
Yeah. So the time decay over time, theta, it's going to cost less to hold those obviously every day. And so when it comes to figuring out which contract do I buy, what's the best strike price, knowing that you're not holding these obviously into expiration, you're selling these when your stop loss or your take profit is hit on the chart according to your trade plan, it's all going to boil down to your upside and downside. Okay. I call this essentially manipulating contracts. And this is what I spent a lot of time doing before entering a position, because say you buy one set of contracts. Well, the risk to reward on one set of contracts, let's just keep this simple and say that the amount you're going to lose on these contracts, even though the same exact outcome is going to happen on a chart, is going to be twice as much as the amount you're going to lose on these other contracts, even though the same outcome happens. Even though you're getting out at the same place on a chart, one set of contracts, you're going to lose 30%. The other, you're only going to lose 15%.
Okay. Yeah, that makes sense.
So that's why we are going to spend a lot of time in the future at actually learning how to go through and really boil down, well, what are the contracts that we actually want to buy? What are the optimal contracts for our risk management?
That was good. That cleared up a lot.
Okay.
That helped me a lot.
All right.
I'm going to fiddle around with it on my own time.
Yeah, this is something you're going to obviously be doing over the next week. So what your homework is going to be and what your homework is going to be is to go through and just really become familiar with options. And if you're on Thinkorswim, being familiar with how to actually go about working through this options chain, looking at the different expiration dates. You don't have to actually place orders, but just familiarizing yourself, like I said, so you can be comfortable with what everything means. You don't need to know how to do the math behind all the Greeks to figure out how that is going to affect your position, because we're going to be covering that, I think, in the next lesson. Now, again, if you guys are interested in learning more about my mentorship group, the first link will be in the description below. You can see everything that is included. And if you'd like to join, you can go ahead and apply. With that said, hope you guys did enjoy.
Let's get it.
See you in the next one.
Buy some option contracts.
Let's do it. All right. See you guys next week. Later. Being able to create a trading plan is vital in your success as a trader. This is episode number 7 in the series where I'm teaching my friend Josh
Hello again.
how to become a consistently profitable trader in the stock market. Now, today we're gonna be hopping on inside my computer. I'm gonna be showing you exactly how to identify where to get in a trade, but more importantly, where to get out. So exactly knowing before you enter where you're gonna set your stop loss and your take profit, and then based off of whether you hit either of those levels, how much money you will make or lose. Now, if you guys are also interested in learning how to become consistently profitable in the stock market, I do have a mentorship group, and we'll put the first link in the description below. So if you wanna head over to my website, check that out. You can see everything that is included. With that said, are you ready to learn how to create a trade plan?
I'm ready.
Let's go. We're gonna go through the entire process of actually identifying a setup, okay? One of the 4 setups that I trade that you've learned.
Okay.
We're gonna identify that setup, and then you're gonna go about setting your stop loss and your take profit, right? Okay, so essentially looking at the chart, analyzing based off of everything you've learned, where are you going to be wrong or where are you gonna be right? And I keep saying that, realize how important this is. We'll set that stop loss, we'll set that take profit on the chart based off the technicals, right? Everything from a technical perspective that you know and have learned up to this point. And then we'll actually go about simulating that trade out using the Analyze tab on our platform. And then I'll give an alternative option that you guys can use if you're not on Thinkorswim. It's an option profit calculator that you'll be able to use to do the same thing as Josh is gonna do. Sound good?
It sounds like a plan.
So I'm gonna let you take over. So I want you to go to trade. Let's go to, you can just open up the, watch list, whatever watch list you'd like. Let's go about finding a setup. We're just gonna start looking through, visually scanning through a series of stocks and trying to identify one of the 4 setups that I trade. 2 of them you guys learned in one of the previous lessons. And then the other 2 are obviously in the masterclass, which you've taken and you already know about, so.
Hershey.
Hershey's, you like that one?
On it.
Add it to our watch list. Yep.
HS1.
All right, that's 1, good, let's find, and what setup is this, Josh?
This is the, it's the 4th one. It's the push.
Pullback play.
Pullback play, yeah, right?
Yeah, over time, don't worry, you'll remember all the setup names, but you were able to identify
I remember what it looked like.
Yeah, that's good.
Pullback play. All right.
All right.
Looks good.
That does look good. So you've got your 2 stocks, SJM and HSY. Both of these present the pullback play setup.
Correct.
Okay. So now what we want to do is if you're on Thinkorswim, head over to the Analyze tab. Now, this is so important. Like without this, you're going to be totally lost. Like you need to understand how to do this. You need to know exactly how much you're going to make and lose on those contracts based off of where you're going to have your stop loss and take profit set.
Okay.
Make sense?
Don't want to be blind going into your contracts.
You don't want to enter a trade having no idea how much you're going to make or lose, which is what most people do. Okay. Obviously, we're on my account right now because you can see the net liquidity is 491,000. So it doesn't matter. We'll pop on your account later. But this is where a lot of the trading comes into play, like the actual trading, the technical analysis part. Where are you going to set your take profit? Now, with this setup, it's a little more straightforward because obviously the intention here is to play the move back down to that low, okay, down to the low. So 107.33 in this case is going to be your TP or your take profit. This is where repetition, practice, and repeating the process of not only identifying the setup, but then identifying where you're going to go about, in this case, setting your stop loss. This is where that comes into play. So let's look at resistance overhead. Let's look at the moving averages first and then say whether they're respected or not. And then let's look at the key levels, all right, or our levels when it comes to the actual candles. So looking at price movement. So our moving averages respected, will any of them come into play within this trade?
The 50-day looks like it's respected. It's probed a little bit, right? Is that too far broken?
It looks like it's traded above it for multiple days.
Yeah, so no, not respected.
I wouldn't say it's respected. I would say that if we set a trade plan and stop out at the 50-day, there's a very good chance we're just going to run up to this next high and then pull back.
So you think, like right around?
The easiest thing to do is go back in the past and slowly chart out your resistance levels. So by charting out the pushes, so when it pushes into a new high, let's do that. So you might not need to start as far back as this, but maybe down here a bit because, right, that's just going to be so far outside of like where your actual target would be, or in this case, your SL would be.
It's right there, 115.
So yeah, there's definitely some resistance here. So 115.75 roughly, right? We can be a little more accurate. You can see that candle did end up actually pushing a bit higher. So just be careful when it comes to actually setting these levels, wherever that highest high is. So yeah, you can see we formed resistance at 115.92. Second 4-hour candle, we tried to push, okay? We were not able to break above 115.92. Yes, like we didn't hit the exact area and get rejected. Price was just not strong enough. Buyers were not strong enough to end up pushing into that area and breaking above. Okay, started trading to the downside, a little bit of a range here, trading flat, started pushing back up. Another attempt. Buyers failed to break above 115.92, pulled back. All right, now we've continued. Looks like, same kind of story here. We're continuing trading lower. And then we traded all the way down into that low at 107.33, which would be our target. Okay.
For the take profit.
Yep, for the take profit. And then again,
back up here.
Cleaner and clearer the chart. Again, it's going to be easier to identify our levels. Again, in this case, we're trying to identify right now our stop loss. So it looks like we've definitely got some resistance at 113.96. So it looks like two tests of this area, pulled back, pushed, one test, wasn't able to break back above. Let me ask, which area would you like to use? There's also definitely a little resistance here just to be aware of. So we've got kind of 3 areas of resistance. 50-day, I wouldn't look at. 15-day, I wouldn't look at. 180 days trading too far above.
Okay.
Which area of resistance are you going to go about using? What looks like the strongest level? Because let's be honest, we want to find the strongest area of resistance, hoping, right? I don't like really using the word hoping, but the intention would be that price would end up getting rejected off that level and pulling back, so we wouldn't get stopped out. And so if this seems like a weak area, or for example, if there's a stronger area above,
use that.
Yeah. And then when you go to actually simulate the trade, well, that's going to tell you whether you can actually put on the trade or not based off the risk reward.
Well, the 113.96 has been twice, right? Exactly twice. It's been hit.
Yep.
These, I don't think that's.
And I wouldn't even count out and say this one's two tests of this one. This one's got 3 tests of this resistance. Let's go with the 3 instead of the 2. Let's just look at the bigger picture here and be like, all right, realistically, if we break above here, where are we going to rally to? Do we want to use this area? That's going to give us a little more room. But looking at our, take profit, we're very close to that take profit.
Yeah. So just the percentage is going to be way higher if we go and do our stop loss up here.
Looks like, either way, looking at the chart, you can chart out right now from where we're currently trading down to our take profit and get that percentage on the chart. And just knowing kind of that rule of 3 to 5% is what we're looking for. If it's, more than or less than, it might not be even worth taking the trade. So like we've got about 4.5+% to the upside to that next level of resistance, whereas only about 1% to the downside, like our target.
So not very worth it, looks like.
Well, we don't know.
Okay.
We can, knowing what at this point, you've already kind of been able to gauge whether this trade is going to be worth taking or not. But I still, for the purpose of this video and, you learning how to actually simulate out the position, will still set this trade plan. So for the example, let's say 113.96 is going to be your stop loss. 107.33 is going to be your take profit, right?
Okay.
Let's head over to the Analyze tab. And let's enter your take profit, which is going to be 107.33.
Here.
Okay, STK price, that is where you're going to enter your stop loss and take profit. So 107.33. Okay, 113.96. And then, we can just zero this out if you want.
What's that?
That's just another area where you could put another level.
Okay.
So are you looking at this screen here? Is this confusing you?
Yeah.
You have no idea what's happening?
I don't know what's going on.
Okay. The only thing we're going to be using are going to be the add simulated trades and the risk profile. Okay. So risk profile, that's where we're going to obviously entering in our stop loss and take profit. And then when it comes to the date up here, this is the only other thing we're going to want to use is the date up here. That's going to be the expiration date of the contracts that we're going to choose. And then the date down here is going to be the date at which we're going to be doing the math behind to figure out what we're going to be up, what we're going to be down, based off of whether we hit that SL or TP on that day. Make sense?
Yep.
Okay, so let's go back to trade. So we've got our trade plan set up. Let's go back to analyze, and we can go over to add simulated trades. Now this is what a lot of my time is spent doing, what I like to call manipulating contracts, which we're going to be essentially trying to find which contracts are going to present the best risk to reward. Okay, let's go ahead. Let's just go with, for example, and if you want to drop that
This
other one, options chain. So obviously under the options chain, let's close that. Now here's the problem. I'm going to say this right away. Looking at these contracts, I'm more than likely assuming that this is not going to be an option or a stock that we're even going to want to trade options on. So if we go to trade, go back to the live market, and we go to add or all products, we've got the December 15th, 2 sets of those. All right, so the issue here is that we've only got monthlies and not many monthlies. So we don't even have weekly expiration dates. We've only got Decembers, we've got Januaries, we've got Aprils, we've got Julys, Jan 25s, and Jan 26s.
Wow.
So more than likely, there's not going to be much volume on these contracts. So let's open up, say, the December 15th contracts. So we could see, looking under volume, we've got a lot of NAs, little volume there. If I see any NAs like that, that's going to be a pretty big, just not a red flag, but more of just a thing to take into consideration, knowing what we talked about in the previous video.
They're super expensive to hold too.
Data is not necessarily super expensive, $10. You kind of have to reference the price of the contract. Okay, maybe if they're only $250 a contract and they're $10 a day, you can kind of see it's going to cost whatever that would be, like a couple percent a day out of that, obviously the contract price. But in general, what do we talk about when there's less volume? What does that mean?
You won't be filled, right?
Less volume, less people trading the contracts, right?
Yeah, so you
Bigger spreads. And then at the end of the day, like, you might not be able to get in, or you'll get in the trade, but you'll get a bad fill and you'll end up paying a lot just to get in, and then you won't be able to get out, or you'll have to, take a big loss just to end up getting filled to get out of the position. There's going to be just that large spread in general. We're going to kind of want to stay away from most stocks that do have NAs, and especially stocks that only have monthlies. Just be aware, or only a couple expiration dates a year. Just be aware, we want to more than likely stray away from those. So you'll kind of get a feel for that as you go about trading over the next couple months. But the purpose of this video, let's go back to the Analyze tab and let's just run through what this trade would actually look like. So Analyze, let's go with the December 15th contracts. And obviously, what is the intention here? We're trying to bet on the stock going down, right?
Down.
So we want to buy what?
A put.
A put, good. So let's go with something a little, more conservative, like, I don't know, the 120s in the money a bit. So again, blue's in the money, and then the dark is out of the money. Okay, so you clicked on buy, obviously, under ask, and now we want to just do the math behind one contract. Okay, just to make it a little more straightforward. Obviously, the percentage gain or loss behind this will end up being the same. Per the whole, position, however many contracts. So you can see we're buying one contract of the SJM December 15th, 120 puts. And then right here, 1260 is the current price that the Analyze tab has said these contracts are currently trading at. One thing I always do is go and reference the live market. So if we go to trade and we go to the December 15th contracts under the options chain, and we were looking at what, the 120s?
Yeah.
So you click on buy. And we can see down here, you've got obviously the spread, 1160 and 1180. Say we got filled at 1160. Okay, just to generally know, it's flipping between 1170, 1160. So let's say 1160, if we go back to Analyze, okay, it's at 1180. So let's change that to 1160. Let's say theoretically, if we got filled at 1160, and then let's go back to risk profile. And this risk profile tool is something that I want you to practice using a lot. If you don't have Thinkorswim, I will link in the description below another tool you can use. If you want to open this right now, it's the optionprofitcalculator.com. So this is the tool that, I would recommend using if you don't have Thinkorswim, if you're on another platform that doesn't offer any way to simulate out the contracts and their P&L open. So essentially what we're going to be using in this case is going to be under basic, long call, long put. So naked call, naked put. So long call, if you want to click on that, or long put, doesn't matter. And then we're going to go ahead and enter the symbol. So SJM, right? SJM. and then it should be able to pull up the current price the stock is trading at, and then you'll be able to essentially just run through everything we're about to do. So 108.62, we're buying, and then you can select the option. So you're gonna go about buying the December 15th. You're under December 15th right now, 120 puts. So there you go. It looks about the same. And then the price was at what, 160?
160, yeah.
Or 1160, sorry. The price was at 1160, so we'll go ahead and adjust that to the live market. Total cost is gonna be 1,160. Great, and then we're gonna go ahead, all right, hit calculate. Awesome. So now you can see here, essentially we've got all of the variables. So depending on when you go about closing that position, so obviously on the left, we've got the strike prices. On the right, or on the top here, we've got the dates. Okay, so essentially how we're gonna use this real quick, very briefly, SJM, obviously the ticker, the prices the ticker is trading at. So let's say SJM is trading at 114 on, December 6th. Well, that means our contracts, if you scroll down, are going to be down, okay, 45% or $530. Now, let's say SJM is trading at 108 on December 11th. SJM is trading at 108. Now our contracts are going to be up 3.1% or $36. So you can just see, right?
Okay.
And these are all the percentages. So you can see essentially and do the calculations as to how much you're going to make or lose. So click on that. Essentially what this tells you is that on, let's say December 9th, okay, if we did close this position, well, SJM was trading at 107.50, okay, the price per contract would be $12.45, okay, which means we'll be making a total of $82 per contract. So you can essentially see exactly how much you will make or lose. I'm not going to go into the depth of using this tool, but we can obviously look at the percentage entry cost and the profit loss. So the dollar profit loss is going to be a little more helpful than the percentage because you can kind of work backwards. So if we're looking at the dollar profit loss, that's what we're going to be looking at on Thinkorswim. So let's say our trade plan is going to be, if we hop back on Thinkorswim, let's say our average hold period is between 3 to 5 days. We're going to want to change this date to 5 trading days from now. December 7th, okay, is 5 trading days from now. That's essentially the longest we're gonna hold this trade. Just know that every day risk to reward is gonna be changing. So the risk to reward every day is gonna change a little bit depending on the contracts, but by going out as far as essentially you will end up ever holding that position based off historical data, even though we don't have that yet, but I'm just telling you based off of the way we're gonna go about trading, you're gonna end up being in positions for no more than a week. So 5 trading days, okay? So essentially what this tool does down here, when we choose the date, that means the math is going to be reflected under P&L open based off of whether we hit your take profit or your stop loss on that day on December 7th. So now we can see if on December 7th, we hit our take profit, okay, right? At 107.33, if we go back to active trader, 107.33, we will be up $107. Okay, that's our P&L open on this one contract, which is currently, well, let's say theoretically, we got filled at 1160. And then 113.96 being our stop loss, okay, right here, 113.96. Well, if we hit our stop loss on December 7th, we will be down $556. Not great. Okay, we'll get into all of that and, actually being able to determine, well, what are we looking for as far as the P&L open? So what is the percentage of loss going to look like behind this? Whether we're making, because obviously the contracts are trading for $1,160. So you can kind of see, well, if we're going to be suffering a $556 loss, that's going to be 40+% of the entire position, which is a lot. Mm-hmm. So that's all going to come into the equation that we're going to use in essentially my risk management algorithm that we're going to dive into. But today, I just want to cover how to go about using the Analyze tab to actually figure out what you're going to make or lose, because then all we're going to need to take is this P&L open, and then we'll pop that into the calculator that I have. This calculator I created, which uses my essentially risk management algorithm, and that'll give you the variables on whether you can take the trade or not based off of historical data, which we will collect. So there's a lot going on here. Yeah, once you start trading. So let's go to trade. Let's go to the next stock, which is going to be HSY. And I want you to identify, again, your take profit, stop loss. And then I want you to run through the Analyze tab, setting those levels, and then getting your upside and getting your downside.
Okay. Okay, take profit at the low, 183.74.
Perfect.
And then I'd say the strongest would be up here. What was that? 199.92.
Yeah, see, this chart is a little
It's choppy.
choppy. So that's why it might just be a trade that you're never going to be able to take because the levels aren't very clear. I definitely think there is a little resistance at 192.94.
Not much though.
There's not much resistance. Definitely an area of resistance at 199.92 and then 200, but nothing that I would be too confident in actually taking a trade knowing that, you know, if I hit that area, I'm out. I'm wrong. I'm losing money. But I guess for the purpose of this video, we're just trying to learn how to use the Analyze tab. But if you want to kind of zoom out here and look at the bigger picture, have you identified, obviously, the pullback play? And then it looks like that 50-day was just recently broken and no longer respected. It looks like trend has kind of shifted. So because of that, I wouldn't even say necessarily that this is a pullback play because knowing what we learned, right, so far, we obviously were following, you know, this very clear, strong trend, clean pattern of lower highs, lower lows, rejections at the 50-day. And then it looks like just recently, we did end up breaking this pattern. Okay, obviously formed that low, but now it looks like the 50-day has not been respected over the last couple weeks. Traded up into the 180-day. You know, it seems like price has been very choppy compared to what it looked like before. And I wouldn't say there's any clear levels of resistance overhead where I'd be too confident in setting my stop loss. We're trading pretty close to that low. But again, for the purpose of this video, the idea is to find that stop loss, take profit, run it through the Analyze tab. So let's just say theoretically, even though this is not a trade that I would take because I don't think that the, you know, pullback play setup is presented anymore. I think it would have been previous to, you know, this breakout above the 50-day and then a move up into the 180-day. I would say, you know, back here, if I was to short, I would have shorted down to that low. Obviously saying that in the, you know,
in the future.
Present, looking back in the past is different. But at this point, knowing that this pattern really has been interrupted and now we're trading in this, you know, chop and, you know, the levels aren't clear, then I wouldn't be taking any trade on this chart. But let's use that. Let's say theoretically, we're going to play a move back down to 183.74. And let's say theoretically, we'll get stopped out at 205, which would be an awful trade.
Yep.
But let's use those levels, and I want you to run through the Analyze tab on your own. You want to show everyone what you just did?
Okay, so I did the take profit at the all-time low at the 183.74, and then I did the stop loss up here at 200.5.
Now the next thing is going to be to go to Add Simulated Trades, okay? And let's just choose a random contract. This does look like a stock we'd be better off trading options with compared to SJM because we have weekly contracts. You can see those yellow contracts and there's more than likely more volume on these, but that's something we would want to go back to the live market and reference and check the volume behind the contracts before we enter any trade. But for the purpose of this, obviously, let's just go with whatever contracts you'd like to simulate. We can go with something which would be inherently super risky, like very far out of the money puts, expiring December 15th, which is just in a couple weeks. So, you know,
Let's do like a 150 put.
Well, there's no one. Like, see how the bid's
yeah.
zero? So, like, maybe choose, like, the 180s.
180. And then ask. Okay.
Okay. Now, what's next?
So one
contract. Good.
where do I set the, where's the limit? Where do I set the price? Did I do something wrong? Right here.
So you can go reference the live market again to see what those are trading at. If you want to go to the December 15th, it was 180. Yeah. Perfect. 88. So that's a large spread. 88 and 95. That's a
pretty
large
big
spread. We haven't looked at the volume, but let's just go with 88. And then there you go. Okay, so we've got our P&L open.
Nice.
$2.
Just enough.
So our upside is only $2 on these contracts, and our downside is 87. 87 is essentially 100% of the contract's value. Obviously, we still have the date being December 7th, at which we would get out of this position 5 days from now, knowing that our average hold period would be between 3 to 5 days. We'll have more accurate data for yourself. And once you start putting on simulated trades and paper trading, actually putting on these trades, just in general, just knowing that, okay, we're only, potentially going to make $2 to then risk 100% of that position.
I don't know, man.
Doesn't sound like a good trade to me.
Could be worth it. We don't know.
So does that make sense? Obviously, you go to risk profile.
And so what's this? Like, what's going on here?
You want to change the date to the expiration date up here.
December
Okay,
15th.
That might change it a bit, but it looks like it's just going to be the same. Okay. So just ignore this. You don't need to use that. I'm not going to confuse you. This is just like a visual way of looking at it.
Okay, so
I don't
that.
look at this at all. No.
Okay.
The idea here is all we need to be able to do is get the P&L open for our take profit and P&L open for our stop loss based off of the levels back to trade, based off of the levels back to active trader that we have set on our chart.
Okay.
Okay. So the TA, the practicing, really identifying these setups, trying to identify one of the 4 setups that I teach, looking to see whether moving averages are respected or not, using either moving averages as areas at which we're going to set our SL or TP or the candlesticks, actually setting those and then getting that, okay, back to analyze tab.
Analyze.
P&L open, getting those numbers. We're going to take those numbers and that's going to help us later on into actually managing risk. But we're going to set a baseline for your risk management when we start out, actually, like I said, paper trading to collect data because like data is king and we can't do anything without data, without having like kind of a benchmark.
Okay.
But that is going to cover everything that I wanted to go over today with you.
All right.
Do you have any questions?
I don't believe so.
Nothing?
No questions or anything.
So what your homework is going to be is, since you have access to the masterclass, I want you to go through under system execution, okay? And I want you to watch the using TOS risk profile tool, essentially what we went over today, and creating a trade plan, okay? I want you to watch those two and just to, again, kind of practice, rinse, and repeat, understand, how this works. This will all just become very second nature to you. So, watch these 2 videos within the masterclass. They'll essentially cover what we covered today, but in a little more depth and detail. Some little things that, if I had added in here, they would have compiled and this video would have taken 3 or 4 hours to film.
Okay.
Awesome.
Sounds like a plan.
Great. All right. I hope you guys did enjoy this video. Again, if you are interested in joining my mentorship group, learning how to become a consistently profitable trader with my help, well, the first link will be in the description below. You can click that, see everything that is included, and go ahead and apply if you would like to. And I hopefully look forward to working with you if you are accepted. Josh and I will see you in next week's episode.
Peace, guys.
Later. Having a trade journal is vital in your success as a trader. This is episode number 8 in the series where I'm teaching my friend Josh
We're back.
how to become a consistently profitable trader. So today we're going to go over data, talk about the trade data that I'm going to have you track, not only so we can make sure that you are consistently profitable once you actively start trading, but at the end of the day, we want to squeeze the most money we can out of your system as a whole. So we're going to go over the trading journal that I use and that you're going to be using moving forward in this series. Now, if you guys want to start on episode number 1, we'll put a link in the description to the full playlist of this series. Real quick before we get started, if you also want to learn how to become a consistently profitable trader, just like Josh, I don't want to take any time to explain what is included. You can head over to my website and see for yourself. If that is of interest, you could go ahead and apply, and I hopefully look forward to working with you. But with that said, Josh, are you ready to go?
I'm ready. Let's do it.
All right, let's hop on inside my computer and let's start journaling some trades. Data is king, okay? Because without trade data, you're never gonna be able to figure out how to manage risk. Managing risk is one of the essential 3 parts, and I consider trading to be 3 parts. I've said this: risk management, trading psychology, and then the actual trading itself. So in this case, the technical analysis that you've been learning. You need data to not only figure out how to manage risk, how to make money over the long run consistently, right? Because the goal is to help you get to the point where you're consistently profitable, but there's also this data that we can collect and track, and I'm gonna cover what that is to really help you squeeze the most money you can out of every trade out of your system as a whole, right? So there's kind of 2 different ways you could go about journaling and tracking this trade data. One way is going to be to actually have a trade journal online. Now there are various options when it comes to trade journals. I'll show you the option that I'd recommend, the option that I've been using, and we'll get Josh set up on what is TradeZella. And then Josh also has a notebook. You can use a notebook too to track this data. Everything becomes much easier and I guess more visual when it comes to actually using a trade journal that syncs with your broker. It's a little more accurate too. If you want to take trading seriously, I definitely recommend to actually get yourself on a trade journal, whether it is TradeZella, the option we're going to cover today, or another option. So first things first, let's set up TradeZella. We'll share our screen now. I've been using TradeZella for the last couple of months, and it is going to help us essentially track the data that we're going to need to use. You're going to be able to track this data while you go about paper trading, which is the next step in your progression. Within the next 2 weeks, you're going to actually start putting on trades. So simulated fake trades, and you're going to begin actually gathering this data that we're going to then take and we're going to use that because I have an algorithm essentially that allows me to not only find that consistent profitability, but like I said, squeeze the most out of my system. So I have this calculator that I actually created using my risk management algorithm that will take all this data you have and punch that into. So we'll cover the data that I want everyone to be tracking to be able to do this and essentially get you set up so we can have this all be pretty automated. So now if you guys are interested in using TradeZella as your trade journal, I will put a link in the description below with a discount code so you can hop on board and follow along with Josh. This is an essential tool, I would say, if you are really, like I said, looking to find that consistent profitability without trade journaling, without data, without being able to correctly track that data, you're gonna struggle to ever make money in the market. All right, so you are officially signed up for TradeZella. Let's go ahead and complete your profile. We'll get this set up and then we'll cover the data that TradeZella is gonna be tracking for you, which is great. So it's just gonna be really helpful and it's gonna help you get to where you wanna be as a trader. So I'll put a promo code in the description below with a link to TradeZella. You can get 10% off if you want to sign up.
So options.
Yep.
I have not tracked my trades in the past. What, trading history, newbie.
All right, so we are ready to go. Now, all I want you to do today is head over to Playbook.
All right.
Now, this is where we're going to add the 4 setups that you are going to be trading. So let's go create a playbook and let's create the first setup.
Got to break a pattern.
Good. You can write break a pattern. We'll go into further detail in this later, but just go create playbook and let's add the other 3.
Later.
All right, so there we go. We have all of the different setups now in your playbook. If you're wondering what the greater than or less than $1 million means, that correlates to my software, which we're going to introduce in a bit. So don't worry. But for now, this is all we need. Now, as far as the data that we are going to need to track to eventually take that data and put it into my risk management calculator, which is then going to use the algorithm I have to, like I said, make sure that in the long run, you are going to be consistently profitable. And at the same time, you're going to squeeze the most out of your system. So we're going to need 3 different data points.
Okay.
It's great because TradeZella tracks all these. So you can actually look at my trade data right here and then within the 4 setups that I trade. So we're going to want to track our win rate, our average winner, and our average loser. And you can see on TradeZella, it'll track your win rate, average winner, and average loser. Okay. And then obviously, you know, your net P&L and expectancy. There's a whole lot of other features that we're going to dive into later on, but we've got your playbook set up. And if you are following along, make sure to get all of your setups set up in your playbook. And so on your dashboard, once we start putting on trades, we will be able to see all of the criteria above here. And then we'll be able to see your performance per day. And then we'll be able to filter for, you know, today, this week, this month, or whatever time frame we're looking to analyze. It's going to be pretty straightforward. If we go to trade log, import trades, we're going to be on Thinkorswim. We're just going to drag and drop the CSV file, and then that trade will be imported with all of the corresponding data. And then once that trade is in there, we'll just go ahead and link up the actual setup that you have in your playbook. And so everything will be tracked manually besides just importing the CSV. Pretty straightforward.
How do you import the CSV?
We'll get to that.
Okay.
Okay, don't worry. So in the last episode, we obviously talked about how to create a trade plan. So trade plan is essential. Anytime you go to enter a trade, you need to know exactly when you're going to be wrong, where you're going to be right, essentially your stop loss and take profit. Repeating this many times because it's super important.
Yeah.
And that is essentially just going to remove all the emotion out of the picture. I mean, if you have a plan set in place and you know, like you have, and this is something you'll build up over time, is like this inner belief or inner confidence. I think inner confidence is a better word. Over time, you'll build up this inner confidence as a trader, confidence in yourself and your abilities, and confidence in the edge that you're gonna have in the market, which is gonna be my software. With that, and then with a trade plan, and then with this risk management algorithm calculator that you're gonna have access to, logging your trades on TradeZella, like you're gonna have everything you need to be consistently profitable. It is just gonna be,
it's gonna be me learning it. It's gonna taking the time, putting in the work.
It's just gonna take time.
Yeah.
But all the tools you need to succeed, you're gonna have access to. And obviously those are available to you guys as well. The next thing is just to introduce you to the software, show you how to pair that with the TA you've been doing, and then you can go off and start trading. It's pretty straightforward, right?
Yeah. I'm so excited.
So straightforward.
Yeah.
Are you confused, or are you like...
No, I really want to just like get kind of into it and try it and see like what I've learned, put what I've learned into practice.
Okay. Yeah. I think I've thrown a lot at you, really, just because we've been trying to like condense all the learning into a couple days and film it, because I wanted to then give you like a couple weeks to go out and start trading, tracking those trades, tracking that data. And so that is going to wrap it up for this video. Pretty straightforward. In the next video, we're going to cover my software, get you all set up with that, and then we're going to actually move on to trading.
Let's do it.
Actually making trades.
I know. Let's get some paper trades going, get some information, get some data, so we can see what I got going on, I guess.
Are you feeling confident at this point?
Yeah, I'm feeling confident.
So your homework for the next week is going to be to go into the masterclass, and I want you to review all of the sections. So everything we've talked about, okay? In the last couple of episodes on the channel, obviously that is all broken down in the masterclass, but in more detail. We had to make these videos, relatively short, so we can end up putting this on YouTube. But I want you to really, really go in and thoroughly take notes, review everything that I cover inside of each lesson within the segments, which correlates to all the episodes we've been through over the last few weeks. Does that make sense? So
yeah.
We've really taken you and given you almost everything that you're gonna need. And now it is just gonna be time to start making some trades, and like you said, collecting that data. So I am super excited.
I'm super excited.
I hope you guys are excited. Again, if you want to hop on TradeZella, definitely recommend it. The link will be in the description below where you can use that discount code. And if you're interested in joining my mentorship group, the first link is in the description below, where you can then head over to my website, see everything that is included, and apply if you'd like to do so. With that said, we hope you guys did enjoy this episode, and we'll see you in the next one. Later. Welcome back to the series where I'm teaching my friend Josh how to become a consistently profitable trader in the stock market. Now, over the last month and a half, I've essentially taken you from knowing nothing about trading to now to the point where you are almost ready to
from zero to hero
to actively, hopefully start making money, right? That is the goal, to become consistently profitable. You are only missing one piece to the puzzle, and that is what we are going to be going over today. We're going to be talking about my edge in the stock market. Now, I think the word edge is misconstrued a lot on the internet when it comes to trading, so we're going to clarify what that actually is, get you all set up and ready to go. So essentially, you have 50% of my trading system as a whole. You've learned over the last 8 episodes everything you need to know, except this one very important piece of the puzzle. So I just wanted to say that if you guys are trying to follow along with this series, we are doing our best part in like making it as easy as possible to structure it in the way that you can follow along with Josh, but it's not that easy. There's stuff I've had to teach him off camera because things come up and he'll text me. And so there's a lot that is just hard to cover at the end of the day on YouTube. And that's why my masterclass covers all of this. So that is located over inside my mentorship group. Now, if you are interested in learning how to become a consistently profitable trader, you can click the link in the description below, head over to my website. You can see everything that is included and go ahead and apply if you'd like to do so. But with that said, let's hop on inside my computer and let's talk about my software and give you access to it.
Let's do it.
So I am really excited for today's video because I'm actually going to be giving you access to what is my edge in the stock market this software, which you're about to see today. And the premise here and really what I want to cover is how you're going to take the software and pair it with your technical analysis and what you've learned.
Okay.
If you guys don't know about my software, I made a video like 2 weeks ago breaking it down, talking about like what this edge actually is, how the software works. But I've been trading on the software now. It's gone through different iterations, variations, but I've been trading based off of this edge for the last just about 4 years. So it was late 2019 is when we totally finished like the development of it. And it took about a year to build. And so like we got to the point where it's very optimized. And so over, the last couple of months, I've slowly been, giving out a couple licenses here and there to different students I have over inside my mentorship and letting them take it, implement it into their trading. And the amount of success so far that I've seen across the board from everyone who's had access, because, up to the last couple of months, it was literally just myself using this and a couple friends, family members, whatnot. But today I'm going to kind of give you a very brief overview of how it's going to work, how you're going to take this and implement it into your trading.
Okay.
And then I'll give you access to about 5 hours of coaching videos that is really going to, help you get to where you need to be to understand how you're going to trade using this, just as I do. But just in general, we went ahead, we created your account. Obviously, you can see we've got sweeps. What you're looking at are essentially orders that have come through. Now, we're taking all of the option order flow data across the entire US. So all of these, and it's retail order flow. So all of the retail exchanges, Robinhood, Thinkorswim, Webull, anywhere you could.
When you mean retail, so not like the big Wall Street guys, right?
These are retail traders, not institutional traders.
Okay.
So these are guys like you and me, guys, girls that, have their own money that they're trading with. And we're taking all this data from all these different brokers. So the second you place an order to, buy or sell an option, we essentially take hundreds of thousands of orders. We've licensed all of this data from these different providers. But we have this algorithm which takes all these orders, we put them through this backtesting engine, and then they're essentially filtered through. And we use different criteria, and we're able to determine essentially what orders come from which individuals. And so the question that I was trying to answer in the first place was, if, there's guys out there with 20, 30, 40 million dollars, where are they putting their money? Mm-hmm. And when you look at an options chain and how you see the volume, say there's like 5,000 in volume behind a contract, how do I know whether that is, one individual buying those 5,000 contracts, or whether that's, 5,000 individual people?
Okay.
So essentially we're able to see behind the order flow of the options world. And we were able to pinpoint, using this engine we built, what orders come from which individuals. And we found that some people are putting on massive size behind certain positions, say buying $1.5 million worth of some Tesla calls that expire in 2 weeks. Mm-hmm. And what they are doing is essentially they're spreading that, say, $1.5 million order out across multiple brokerages. So they'll put 50,000 here, 150,000 here, 200,000 here. And there are two reasons why they're doing that. So the first reason is simply due to liquidity, right? If you have 100 or 1.5 in this case, $1 million, you're not going to be able to theoretically buy up that many contracts because there's not enough people to sell to you. Mm-hmm. And so by spreading out that order, they're able to essentially get in that position, while at the same time and this is where the edge comes in, we figured these people were going through all this trouble to essentially hide this position, to mask this order by spreading it out across multiple brokerages. So
it's the same
in a
contract, just they bought it at a bunch of different brokerages.
Think about what would happen if you put in a massive order on some contracts. There would be a huge spike in the volume and the open interest, right? People would see that, algorithms would pick up on that. And this is the word I use, this matching engine that essentially all the data runs through is able to use certain criteria to then determine whether that, and it is called a sweep, because whether that order came from one or multiple people. And what the sweep represents is the fact that someone is coming in and they're buying up all of these contracts across multiple platforms. They're coming in and they're sweeping up all of these contracts. So we realized, like, okay, there's definitely guys out there that are trading massive portfolio size, could be $50 million. They're putting on huge amounts of capital, a lot of cost behind these positions, some being very, very aggressive trades, where we know the basics when it comes to options, right? Inherently, there's more risk with contracts that have a closer expiration, or contracts that are, say, further out of the money. And so using kind of risk and certainty kind of paired hand in hand, we're able to see based off of the risk that is, behind this position, looking at the criteria when it comes to options. This guy is very certain about this position. Does that make sense? So anyone who just put $4 million on Microsoft puts that expire this week, they definitely
pretty
think
certain about
they're pretty certain Microsoft is going down, and the next morning when the market opens, they're going to be up or down, it could be $500,000, right? Depending on how much the stock moves. But we started simulating these sweeps over, the course of this year. And we found that some just yielded these like crazy expectancies. Like these guys, girls behind these orders, behind these sweeps out there trading, trying to hide this massive cost size. When you see cost, that's what the order size is. So someone just put $3.5 million on these FIVN calls. They know something that we don't, right? Obviously, insider trading is illegal, but there are people
that might know something
inside. And so the idea is what I started doing, and this is what you're going to learn to do, is taking this sweep. And this is how I actually find the stocks that I'm going to trade. They're just the stocks that come through, okay, the sweeps that come through, right, on my software. And then I pull up the chart, and then based off of the chart, from a technical perspective, I try to identify whether there is a trade there or not. And if my bias, when it comes to the chart, aligns with the bias behind the sweep, for example, I identify my ATH pullback setup, which you've learned over the last couple of weeks. Okay, that means that I'm betting on a stock if it presents that setup to go down. Well, if the sweep is a put, if someone bought puts, that means they're betting on the price of that ticker to go down. Well, then my bias aligns with the bias behind the sweep. So it's like really 50-50. I say 50-50 in the sense of half of my trading is everything you've learned up to this point. It's the technical side of things, those 3 setups that I'm trading, and then how to go about, looking at a chart and identifying one of those setups or not. And then the other 50% is taking the software and then obviously looking at these sweeps that come through. And based off of the criteria behind the sweep, we're kind of able to judge or gauge the certainty. And then we know, the stock that we're going to trade in the first place and what stock to actually look at from a technical perspective. And then we know what direction to bet on that stock going as long as our bias, right, aligns with the sweep. So this is my edge. This is, I will say up to this point, and you might have heard of order flow softwares or order flow algorithms. Up to this point, I haven't been able to find anyone that has been able to pull these orders that we do.
Okay.
And I think that has to do with the way we're actually first going about gathering all this data, collecting this data. But then I can't take all the credit, for building this. It was, myself along with a couple of other guys that really came in and made this happen. I had this idea of when I look at an option contract and I see this volume behind the contract, how do I know whether that's one person or multiple people? And then some very smart people helped me. Some very smart minds, let's just say, came together to actually build the matching engine. That's my term, to take all these orders across all these retail exchanges, filter them using this criteria, figure out if they came from one person, multiple people. And then we found out that, oh shit, some people have massive portfolios. Yeah. Clearly, they're trading massive size. They're going through all this trouble to hide their order. Are they actually profitable or not? And then we paper traded all of these, simulated all of these sweeps out, found that some yielded higher expectancies than others, and that these people were actually making a lot of money. And so you'll see over time, it's pretty unreal to watch as a sweep comes through, and then the next day you go back and you look at that stock, you reference that sweep, and you're like, oh shit, this guy, like literally you can look at the contracts. This guy just made whatever, a couple hundred grand.
Amount of money, yeah.
Yeah, it's insane. And
that's
so
crazy. This
is the software that I'm going to teach you how to use, and most of the learning is going to be for you done through watching about 5 hours of content that I put together to help you, which we just simply can't put on YouTube.
Yeah.
Too long. And I'm really excited to see you take this thing
really excited
and implement it into your trading. So any questions, or does that make sense?
Makes sense.
What you're looking at now is obviously the current version that I'm trading on. So all the data is the same. The matching engine's the same. We're pulling the same sweeps. We've just added some functions and, made it easier to actually get people on this and let them use it. My long-term vision in this is a lot bigger than just, having a couple people use it. And I think there's some big things we could do with it.
Yeah, for sure.
But, pairing it with our trading, with my trading, with yours in the immediate term, this is going to help us find that edge, give us that edge essentially that we need to make money. So first, up here, we've got the call volume, the put volume, very simple. You can see the amount of calls that have come in and then the amount of puts that have come in. So one thing that we can also utilize the software for is giving us essentially sentiment behind the overall market. So we could see whether more people are having a bullish, point of view or a bearish point of view. So you could see if there's more calls than puts. Well, generally more people are betting on the market or all these stocks as a whole to go up. So you can see the market sentiment today is bullish. And then you can kind of reference today. Okay, we're green on IWM, QQQ, we're a little bit red, SPY, we're a little bit red. And then you can kind of look and see, we'll get into the criteria, but I've seen this, the sentiment will be very bullish for like 4 or 5 days. Market will be red, selling off. And then all of a sudden we'll come in with this huge rally and all of these positions will just skyrocket.
Yeah.
It helps definitely to gauge overall market sentiment. This isn't like a buy or sell signal or anything like that, but 6 calls today, 2 puts today, 200% more calls than puts, just to give you some perspective on where people are putting their money, right? Because this is like a look behind the veil of
where people are putting a lot of capital.
This is, yeah, exactly. That's a good way to summarize it. So let's go first to add filters. Essentially, we want to keep exclude sweeps unchecked, keep exclude underlying stock unchecked, keep exclude underlying ETF unchecked. That means we're going to be looking at the sweeps. You're going to learn, obviously, what trade and flag means in the material that I'm going to give you. But we want to see sweeps. We want to see, obviously, stocks and ETFs. Okay, now this is all of the information when it comes to option contracts that we have the ability to look at. Now, I'll show you exactly what I look at, and then you can kind of decide whether you would like to check or uncheck, whether you want to see more information or not. But really, this is the baseline as far as what I'm going to look at to determine, whether that is a sweep that I want to take or not.
Okay.
So essentially, these are the filters that we're going to exclude, include. This is everything that I'm going to look at to make my decision on whether this is a sweep that I want to trade or not. So we've also got minimum cost ranges, expiration date ranges. You'll learn about all of that and what that means. So here's what we're going to look at. So we've obviously got the date. Okay, today is the 6th. The time, this is the time the sweep came in. Okay, second the sweep comes in, it comes through on the software. So you can see time for each sweep today, first sweep coming in at 9:45. Then we've got the ticker. Okay, so all of these stocks that are being traded. We've got whether it was a put or a call. Then we've got the strike price. Okay, you know what the strike means, obviously. And then we've got the expiration date. And then we've got the cost. So strike and expiration, those are going to be 2 of the variables that are going to help us gauge certainty. And then cost, we'll see anything between 100,000 to sometimes you'll see $5, $6, $7 million sweeps. So 126,000 to 3.5 million is kind of the range today. And then we have the price. Now, this is another very important variable because this is the price of the contract that was purchased. Okay. So for example, this buyer just came in at 12:07. They bought up the UAL puts. They bought the $45 strike. Okay. These contracts expire on December 15th, 2023. There was a total cost of $180,000 behind this position. So that's how big the position was. And then these contracts were going for $360 per contract. And then obviously we're looking at sweeps. You're going to learn the difference between sweep and trade and red flagged, all of that later on your own. And then the sentiment, obviously bearish or bullish, whether it is a put or a call. Bearish being puts, bullish being calls. So we can take out sentiment if you want. And then, it is up to you whether, like I said, you would like to add, remove the data that we have the availability to look at. So that's all I look at though.
Okay.
Very straightforward. Certainty and risk. When it comes to the expiration, the closer to the expiration, those are going to be riskier contracts. They're going to be more volatile. They're going to be, moving faster, theoretically, right? Based off of whatever stock is being traded. So if we are swing trading, that's the whole premise of what I do and what you've been learning how to do. We are going to want to stay away from any sweeps that expire the same day. And typically I'd even say the same week.
Okay.
Obviously, if someone is buying a contract that expires the same day, they're not going to be able to hold that position overnight because the contracts expire. Typically, the same week expiration, those contracts are going to be so volatile where they're essentially just going to be too risky to even hold overnight. And when we use the Analyze tab and we actually simulate out the position, you can see that more than likely those contracts will get crushed if you're wrong. Or you'll make a lot if you're right, but
super risky.
I'm looking typically to not touch any contracts within 2 weeks out.
Okay.
So I'm looking to trade contracts that are over 2 weeks out expiration, and just know there's no right or wrong answer because it all comes down to your data.
Okay.
And like how you trade the sweeps. But we're swing trading, no trading same day, same week expiration, preferably 2 weeks out. The higher the cost, generally, there's going to be more certainty. There's more money behind that position. Theoretically, therefore, the outcome will be increased. The win rate behind, that say cost basis is going to increase. Generally, the smaller guys or the smaller positions when it comes to the software, I know 126,000
The little
is a
guys.
lot. The little guys. That is, a much smaller bet than say the $3.5 million bet. So kind of using that certainty aspect. And then the strike price, how far in, how far out of the money. The further out of the money, obviously inherently riskier. The further in the money, safer. So you'll see someone coming in with, say, $3.5 million. This guy bought up the FIVN calls, the $90 strike. Now, if you want to, if we go to add filters and display spot. Now, the spot is the current price that stock is trading at the point where the sweep comes in. So this sweep came in at 1207. UAL was trading at $41.50. Okay.
Got it.
What we can kind of look at, obviously, is if it's a put, someone comes in buying both puts, we're going to look at the spot, and based off of that, we know whether they're in the money or out of the money. And then the same thing goes for calls. Okay, you can look at the spot, we can know whether they're in the money or out of the money, or you can just look at an options chain. I actually don't even have spot on here because I'll just pull up the options chain on TOS and look at it.
There, yeah.
So essentially, the further out of the money, the closer to the expiration, the higher the cost. That's a lot of risk, a lot of certainty. And then the further in the money, the strike, the further out the expiration, and the smaller the cost, that's less certainty. And so think about it like this. If you see someone come in, they buy up some contracts that expire in 2026, and they're very deep in the money, ask yourself, do you think that move is going to be happening within the next 3 to 5 days, knowing that generally you're swing trading, you're going to be trading the way I do, my optimal hold period is between 3 to 5 days. Do you think that move is going to come within the next 3 to 5 days? They're betting on that move. Yeah, they're betting on that move to happen like over maybe the next couple of months. So keep that in mind too, based off of the way you trade and looking at the contracts. I just know if I was going to be trying to capitalize on a long-term move, say I'm trying to capitalize on maybe a 10 to 15% move on a chart over the next 3 or 4 months, I'm going to buy contracts that are super far out, very far in the money. You're going to get a feel for looking at the cost, looking at the expiration and the strike, gauging certainty and risk. And then based off of those factors, well, we can then go about pulling up the actual chart. Okay, so whatever the stock is, and looking at the chart from a technical perspective. So I want to run through a couple examples, and we'll even just go through all the sweeps that have come through today. So we'll look at the sweep, kind of identify the criteria, kind of look at the variables, right, that I look at. And when I say variables, really it's the strike, expiration, cost. And then we can even look and see what the current price of the contracts are trading at. So if this guy got filled at $360 a contract and we see they're going for $450, maybe that move has already come and gone.
Yeah.
Right? Does that make sense? So we want to make sure we're not getting in a position that might have already happened.
Okay. That
because
makes sense.
without being the broker, you'll never know when these guys are getting out of their position.
Yeah. It
That's
could be
impossible.
like a quick, same day thing.
That's the thing. Even someone could theoretically come in and buy contracts that expire in 2 years and sell them 2 minutes later.
We just don't know.
Keep that in mind. We don't know. But we know what stock they're betting on. We can gauge certainty and risk. And then we can decide whether, based off of our technical analysis, everything we know, that's a trade we want to take or not.
For us.
And that's our edge.
Okay. Makes sense.
Cool. All right. So I'll run through the first couple, and then I'll have you run through like a couple more.
Sounds good.
All right. So we've got RPHM calls. So let's pull up RPHM. Okay. So right away, it looks like we're kind of trading in the middle of this chart.
It's kind of
in the
choppy
sense of, the lows at 508, the highs at 1130, very choppy.
None of the moving averages
not
are
clean.
respected.
No moving averages respected. Direction isn't clear.
Let's do it. Let's trade it.
On to the next one.
On
right?
to the next one.
So our next sweep, Microsoft puts. This guy bought up the 410 puts expiring January 19th, 2024, $676,000. And these contracts are going for 3.8K. So they're more than likely pretty far in the money, just knowing Microsoft and how those are typically priced. Let's go ahead and pull up Microsoft. What do we think here?
What was it? It was a call? Or is it put? I forgot.
Now, this is something I'm going to have you do when you go to practice. I want you to hide whether it's a call or put. So I want you to hide whether it's a put or a call, and I want you to hide the sentiment. And then I want you to look at the ticker, pull up the chart, look at the chart. What is your bias on the chart? Is there a trade there or not? If yes, then let's look at the sweep. If no, let's look at the sweep. And if the sweep doesn't align with your bias of the chart, you cannot take the trade. That is very important. So what would your bias be behind this chart?
Well, I do think it would be a put because first off, it broke through that 50, which was respected a little bit, but it also just hit that all-time high.
Okay. But is there a setup here? ATH pullback, ATL bounce, pullback play. No, we're trading too far off the high. There's nothing here. This chart would be the closest to the ATH pullback, but it's not. Are you getting this? It's pretty straightforward. All right, next, DAL. Now, this guy bought up DAA calls, the $45 strike expiring 4/19/24, about $1.2 million on this position. Filled at 125 a contract. DAL. And what do we see here?
Nothing much.
Nothing. Okay. No setups.
No.
Good. So you're getting good at identifying whether there's a setup or not. Okay. IWM. Now, this is kind of my rule of thumb is I don't trade SPY, QQQ, or IWM.
Noted.
Okay. Those are ETFs. Now, you can trade ETFs, but I would stay away from those three. Okay. VEEV. Now, notice how we're not even wasting time going in and looking at, the fill price, what the contracts are currently trading at, gauging risk, gauging certainty. The first thing we want to do is just look at the chart. Is there something there or not?
No.
Is it worth our time? No. This is way too choppy. No clear direction. No moving averages respected. No pattern. No trend. No setups. Nothing.
Nothing.
All right. On to the next one. I'll have you do this one. This is a big one. $3.5 million in cost.
How do you do the
That's a lot of certainty.
exit?
Hit this. Whoa, what's going on there?
Nothing really respected. It just hit an all-time high, but it's super choppy.
And it looks far off that all-time high.
Yeah. It's way back down at 81.69.
What do you think?
No.
Dang, that was a big sweep. So this is something that I think you'll be good with this. But don't get FOMO behind the sweeps.
Yeah.
There's a way you can misuse the software. Just jumping in on the sweeps when they come in and being like, letting your bias just, I guess, disregarding your bias behind the chart, by looking at it from a technical perspective, disregarding that and then just taking the trade. And one thing that I do is I enter all my trades between 3 to 4. So even if the sweep came in at 10 o'clock in the morning, I'll look at the chart and then I can see, well, maybe this move has happened or not. And if the move hasn't happened, if there's actually a setup there, a trade to be taken, and then, I'll go about creating my trade plan, stop loss, take profit. I'll first start by typically simulating out the exact contracts that the individual bought, getting, the upside and the downside, putting those into my risk management algo, which you're going to also have access to soon. And then I'm going to take the trade or not based off of whether I can. So we'll do the whole process. We'll go through the whole breakdown eventually, everything A to Z. But let's go on to, PSTG.
So choppy.
Choppy. And we've got a lot of choppy charts. Don't like it.
DIA.
Yeah.
DIA.
I think it was DIA.
This one's better. But just hit the all-time high. It's still choppy, though. Right?
Let's look at the immediate trend. Okay. The immediate trend is pretty clear.
Yeah.
Because we're not, obviously, the longer we've seen a pattern play out, the longer a trend has played out, the longer moving averages have been respected. This is going to help us, obviously, determine how or whether those levels will hold or not. But when it comes to our trading and knowing that, we're looking to swing over 3 to 5 days, the margin for profit we're looking for is not really going to ever dive down into that 10, 15% below where we're currently trading or above. We're not really going to have to take into consideration anything that has happened really 2-3 months prior. So let's look at the last month or so, look at the immediate trend, and we can see we've started respecting averages. The trend is very clear pattern of higher highs, lower lows. Recently formed an all-time high in the 4-hour, trading above the 15-day EMA, which is respected. And we can kind of make a decision. Well, first off, what's the setup? What's the bias?
All-time high pullback. Bias meaning?
What direction would you bet on the stock going?
Down.
Okay, so let's look at the sweep.
They did a call.
Okay. Your bias on the chart doesn't align with the bias behind the sweep, or the direction of the sweep, right? So that guy was betting on DIA to go up, and you would bet on it to go down based off of what you're looking at from a technical perspective, which means this isn't a trade that you would take. So that's everything today so far. Okay, it's 1:30. We've gone through all the sweeps. I think over time, and depending on the days, some days there'll be more volume of sweeps, some days there'll be less. And over time, you'll get faster at going through. It takes me probably 15 minutes to go through all the sweeps that have come through on that day really quick. And then I'll build out my watch list. So essentially, if you go to your watch list, this is how I do it, how I like to do it. If there were any sweeps that you liked right away, you identified a setup before even looking into them any further. And this is all the stuff you're gonna learn through the curriculum I put together just for you. You're gonna add that stock to your watch list. And then once you've gone through all the sweeps, whether it'll take you 10, 15 minutes, say you're going through the sweeps every day between 2:30 to 3, and then you're adding all of the ones that you like to your watch list. And then, from 3 to 3:45, you're actually figuring out that whole trade itself and doing everything, like the whole process, and putting on the trade or not.
Okay.
So there's nothing so far, but we'll, check back in later today and look. But do you have any questions for me as far as how you're going to pair my software, my edge with your trading, the technical analysis?
No, everything that you explained to me so far makes sense on how I'm going to use it. I am intrigued to see what the 5 hours of learning is going to have in store for me and what I don't know.
Okay.
But so far it makes sense.
Okay, good, awesome. So that's everything I want to cover in today's video. Now, next week, you're actually going to start trading, okay? You're going to start trading. I'm excited.
I'm excited.
I hope you are. I'm going to give you a week to really dive into that curriculum I put together. You're going to learn how to fully utilize the software, trade using it how I do. But generally, that was the overview. That is what my software is, my edge in the market, how I've found that consistent profitability year over year. And now you have access. So again, this isn't for sale, but all my teaching and everything that you're learning, that is all over inside my mentorship group, which will be the first link in the description if you guys are interested in learning more. And if you want to become a consistently profitable trader. So we hope you guys did enjoy this one, and we will see you in the next video.
Bye, guys.
Later. I'm going to be giving my friend Josh $100,000 to trade with.
Oh, yeah.
This is episode 10 in the series where I'm teaching you how to become a consistently profitable trader. And so today, everything is kind of coming together, and you are about ready, almost, to start actually trading.
Today's the day.
Today's the day. I'm going to cover a couple more things that you're going to want to know. Now, we've spent the last 9 episodes. Essentially, I've taken you from knowing absolutely nothing about trading to now you're at the point where you're almost ready to go. You're almost ready to actually actively start trading in the market.
It's almost that time.
And so if you guys want, you can head back to episode 1 and kind of progress through to episode 10, which we're on right now, to learn with Josh. And if you're interested in learning how to become a consistently profitable trader, the first link in the description will take you over to my website. That covers everything that is included in my mentorship group, where I'm actively helping other students just like Josh learn how to become consistently profitable. So with that said, let's hop on inside my computer and go.
Let's do it.
Let's go. Okay, so we are actually finally gonna get you into some active live trading. However, not real capital. We're gonna start off through paper trading. And the idea here, and essentially the goal, is to not only learn, practice, obviously rinse and repeat everything that I've been teaching you over the last about 2 months, but to start collecting the data that we're gonna need to go about properly managing risk, so we can make sure that in the long run, you're not only profitable, but you're squeezing as much capital you can out of each and every trade. So I have an algorithm I use to manage risk. It's a calculator that you'll have access to once we go about collecting data. And so I'm gonna have you go off on your own, spend the next 2 weeks taking everything that you've learned, start making trades. The goal isn't to make money. Obviously, you're just going to be trading on a paper account. The goal, like I said, is to learn, to practice, and to collect this data. But we need to set a baseline as far as how you are going to go about managing risk, because we want to be theoretical about this. We want to be realistic. And so if you have, and this is your plan, is to start with a $1,000 account, which is most people, and that's a lot of money for most people to start out with $1,000. But it is very hard to properly manage risk, but we'll set kind of a foundation to at least make sure that you don't blow up your account, as that's what happens with most people who start out trading, to get you on your way so we can collect this data so you can really take your trading to the next level. So this is how you're going to go about managing risk. Okay. Obviously, when you actually find that stock that you want to pull up from my software, you look at the chart, you identify whether there's a setup there or not. You check off all those boxes and then set up your trade plan, stop loss, take profit, bring that trade into the analyze tab. You simulate out that position, and then you figure out the risk reward in the contracts. Well, this is the criteria we're going to go based off of. So you're going to have, theoretically, you have 100,000 in paper money, but we're going to size and we're going to trade as if you only had $1,000. So your account size is $1,000. Your position size is $500. That's 50% of your account size. That's the problem with having it's a little aggressive, right? That's the problem with having a small account. But here is how we're gonna, make sure that as long as you're sticking to your trade plan and you're calculating the risk to reward out and you're making sure that you're within this criteria, you're not gonna blow up your account. You're gonna be able to actually put on trades, as most option contracts cost at minimum $100. So your minimum R to R, which is your risk to reward, or your R, however you want to say it, is going to be a 1 to 2, which means you're risking essentially 1 part or $1 to make 2 parts or $2. And then your optimal risk to reward, this is what I really want you to shoot for, is going to be a 1 to 3. Okay. And here's what's very important. Your downside and your upside. Now this is in percentages. So your 1 to 2 is going to be a 10 to 20. That means you're not going to lose more than 10% on those contracts, whereas you have a 20% potential to make 20% profit on that contract, as long as it is within that $500. So you can buy 1 contract for $500, you can buy 2 contracts for $250. But when it comes to your trade plan, when you go about setting up your stop loss, your take profit, you're going to have to manipulate and essentially go through as many contracts as you can to find contracts that present that downside of 10% and that upside of 20%. Now, your downside has to be under 10. It can't be above 10. Theoretically,
of what?
Less than 10 of the actual, and we'll get into Thinkorswim and I'll give you some examples, but of the total position size. So out of that $500, you want to keep that downside under 10%, theoretically as small as possible, right? You're not going to be at exactly a 1 to 2. It's not going to be exactly 10 and 20. That's going to be almost impossible. But say this is 7 or 8 for the downside, and the upside, theoretically, you want this to be as high as possible, or a little bit over 20. Like, we got to go about setting realistic expectations. So let's say the upside is 20 or above. Okay, the downside is 10 or less. So within that 1 to 2, again, there's going to be wiggle room on either side. And then the optimal RR is going to be a 1 to 3, and that's going to be a 10 to 30. Okay? Now, you're going to go about taking each trade. You're going to have to spend a lot of time running through, simulating the contracts, finding the best contracts that present that 1 to 2 or 1 to 3. And then you have to stick to your trade plan. You have to get out exactly where you plan on getting out, whether that is for a win or a loss. Stick to that trade plan, so then we can have some consistency, start to build up that data that we're going to take, because we are essentially going to be looking to collect what is both going to be your win rate per setup. So we're going to have your win rates per the 3 setups that I teach, and then your win rate altogether. So when you combine all 3 setups, and then your average winner and your average loser per setup, and when you combine all the setups.
Okay.
Does that make sense? So that's, once we have all that data, we'll go about getting that actual win rate, the upside and the downside. You have your trade journal that I set you up on. So that is all essentially going to be automated, besides collecting the upside and the downside. So let's run through the whole process.
Okay.
Right now. Let's run through the process A through Z and send you off. And over the next couple of weeks, you're going to start taking trades and collecting that data. So I'm going to let you take over. And step 1, obviously at this point, you know how to use my software. You've taken the curriculum I put together, teaching you how to utilize the software just as I do, how to trade with it. And now you're going to go about actually going through the sweeps, pulling up the stock, identifying whether there is a trade there or not, and then setting up that trade plan, running through the risk to reward, simulating the position, seeing if it's within that criteria as far as managing the risk, and then putting on that trade.
All right.
So let's first just start off by going through, how about the most recent sweep that came in, GDDY? Why are you going,
Could be an all-time high pullback.
Okay, so one of the setups that you've learned out of the three, this chart you think presents. So let's run through kind of what we're looking for in an all-time high pullback. And do you want to use that? Did you write down the checklist I sent you?
No, I have it on here though. I was trying to add it to the playbook, but I didn't know how to add it.
I'll show you. We'll get your playbook set up.
Can we read off of this?
Yeah, you can read it.
So we're looking for a bullish trend. Check. Sitting at the all-time high. We're just below. So we're sitting just below at 103.49. And then the all-time high actually just formed. Perfect. 15-day EMA currently respected. Correct.
Either one needs to be respected.
Okay, one or the other.
Yeah, and then it goes, because that's going to essentially define how you're going to go about managing the trade. So if you look at the trade management, then we can decide based off whether the 50 or the 15 is respected, how we're going to manage the trade. So it looks like everything that we're looking for here is pretty solid. And I think I have like a 76% win rate right now with the ATH. We want to look at the margin for profit between where we're trading to the 15-day and then to the 50-day. And then from where we're trading to that 105.47 ATH. So that would be your stop loss at 105.47. Slightly above, remember the rules, something that you learned in the master class.
It's like 2% above.
Okay. So right above that area.
And then down to the 15-day.
So yeah, down to the 15-day would theoretically be your target.
1.2. To the 50-day, looking at 7.
Now let's look at the trade notes. Let's look at the trade management. So we can play a break below 15 and short to 50. All right. We can play short off the ATH down to the 15.
Which would be that 1%.
Which is 1%. Or we could short off ATH down to 50. Which, depending on the chart, this chart, obviously, we'd short through the 15, which is support. Or we can play the break below the 15 and short to the 50, which is support. So right now, where we're currently trading, and it being 240 already, if the risk management aligns with what we're looking for, well, let's set up our target. So in this case, we'd short off the ATH down to the 15. I would say in this scenario, based off of this chart, the 15-day has been very respected, and we could easily see a continuation of this pattern again and short down to the 15. I think a break below, actually breaking this pattern, breaking below the 15 and shorting to the 50 is not going to happen when we look at moving averages on this chart being respected. We have not broken below the 15. So maybe there's not going to be enough margin for profit, and what would happen is that we're actually going to end up risking more than we could even make. So let's set our target at the 15. Okay. Now we want to set it slightly above the 15, remember.
Oh, yeah.
So when it comes to being short, we want to set our stop loss slightly above resistance to give the market that chance to probe that area. People get shaken out, it retraces. And then when it comes to our take profit, we want to set it slightly above support at 102.24. Okay, just give it a little space on the top. Okay, so let's go to the 1 minute just to get some kind of reference. Just zoom out on the 1 minute. I just want to look at today. So there you go. Generally, that's obviously we're not ever doing our work on the 1 minute, but it's good to look at. It just gets you more familiar with the actual chart and how it's been trading on the day.
Sounds good. So now analyze. Risk profile. So first I have to take in my stop loss, which is at 105.59 right there. So I put that in under the strike price.
Yep.
And then I have to put in my take profit, which is at 102.24 right here. So enter that and then go and actually look.
Go back to the software. So this guy just bought up the GDD $100 strike puts, obviously, expiring January 19, 2024, 102,000, and he bought them for $155 a contract.
Okay, so
January 19th, 2024. So let's pull up the Jan 19th, 2024 contracts and the $100 put.
just out of the money.
So let's buy one of those, simulate it, and I would go back right now Oh, you are good. Stay.
I just want to see like the volume.
Good,
and
good. I
stuff.
was gonna tell you. Yeah. So look at the volume. Obviously, this is in the actual live market. We're not simulating this yet because we want to reference the volume to make sure there's enough volume on the contract. So you can kind of look at the 100, the 97.50, the 92s, the 105, and just make sure there's actual trading happening, right? We obviously want to look and see these contracts currently are trading for 155. Let's just go back and reference what this guy got filled at. So he got filled at 155. So he's even, he's flat on this trade. Obviously gauging certainty, gauging risk. Okay, a little more conservative. Expiration is about 2 months out. He's one space out of the money. And this is a smaller cost, okay? 102,000. 158 they're trading for on the low end. So they're going up a little bit. So let's go to the Analyze tab.
Add simulated trades. Go to January 19th, 2024 for the 100.
158. You can change that too. Good. One contract. Now, let's just use my data because setting the trade plan up, doing everything, that I do, you're going to be sitting at around a 3 to 5 day hold period. So we want to go as far out as possible. So let's go 5 days. That's the longest amount of time we'd end up holding a trade based off of our averages. And we'll run the risk reward based off of that day. So 5 trading days. So today's the 6th. So Thursday, Friday, 13th. Yeah. Well, 5 trading days, not including today.
Okay.
So the 13th. So you could be in the scenario where you end up holding this trade over the weekend. Do keep in mind that, based off the chart, we want to prepare for the worst case, as in the worst risk reward. If we get stopped out a week from now, 5 days, knowing options, it's going to cost us more and more every day because theta. And so as long as our risk reward is going to be good, like kind of the worst case, then we can enter it. But obviously if we get, if we hit our target tomorrow, we're going to make way more than we would if we hit our target in a week. But we want to go as far out as possible. So we have the flexibility to know that even if we get stuck in this trade, even if it takes longer for that move to happen, whether we get stopped out or take profit, it's still within the risk reward as far as the trade we could take. Because the risk reward is going to change each day. And that's the way I've found to work the best for me.
Okay. That makes sense. So doesn't look like a very good risk.
So yeah, you can see obviously
It's a 3 to 1, not a 1 to 3.
Our downside is going to be $66.91, and our upside is going to be $22.97. So it's a flip risk reward.
Yeah, not good.
That's not good. What would you do in this scenario?
Do you look at other contracts?
We can go about simulating more contracts. However, just keep in mind that if you're so far away from, that baseline, that 1 to 2 or the optimal, the 1 to 3, I mean, we more than likely won't be able to find contracts that fall within that risk reward that we're looking for.
So on to the next
And
sweep.
then keep in mind, you also have to look at the upside and downside percentage. And these contracts are only trading for $158, $67. That's a $67 loss on a $158 contract. That is whatever the percentage is. And that's going to be substantially outside of your 10%. Does that make sense? So yeah, unfortunately, this seems like it might not be a trade we could take. However, you can go through and manipulate out more contracts to see if you can find that optimal risk reward. But I'd say, for the purpose of this video and learning, let's move on to the next sweep. So if you want to go back to the software, and then we can go to JWN. So really choppy.
No moving averages are respected.
No moving averages are respected. You're right.
On to the next. Nova.
That looks very similar as the last one.
Nothing.
I don't see anything either. The next step, and let's go back to GDDY and use this as an example, because the next step, and let's say theoretically, this trade looked great. Now we're within that 1 to 2, 1 to 3. The upside and the downside percentage aligns with obviously your risk management. Well, now we can go about actually putting on that position, buying those contracts. So theoretically, let's just say you could have bought 1 contract. And what we're going to do is we're going to then put that position. We're going to export that position out of TOS, drop it in your trade journal. We're going to go about logging that trade. Okay. And then collecting that data we need to collect. You might end up entering this. You might hold it for the next day or 5 days. You manage that trade exactly according to your plan. Okay. Stop loss, take profit. Again, don't worry about losing money, even though it is paper money. One thing we're going to get into when you transition into live capital is going to be really the psychological element and aspect of trading. Trading psychology is a huge part of trading that you'll have to really conquer. But like I said, the purpose of this is technical analysis. It's collecting this data we need to properly manage risk. Even though you have a small account, if we have data, we could properly manage risk, in my opinion. There'll just be less opportunities you can take because a lot of the trades that might look good, they're just going to be outside of that range as far as like you can only put on one contract or you couldn't even buy a half a contract. Right?
Yeah.
Does that make sense? What I'm going to do is I'm going to let you go off on your own. I'm obviously going to make sure that you're all set with your trade journal to actually start tracking this data and logging it. And then you're going to come back and in a couple of weeks, we're going to touch base. We're going to look at all your data. We're going to look at your win rates for each trade. Okay. We're going to collect the average winner and the average loser. We're going to look at this data and then we're going to make a decision on how to go about moving forward and transition into trading with live capital. So that's the goal. So let's fast forward theoretically. Let's say you have now taken that trade. You got out of that trade in this case for a loss. And the next step is essentially just going to be to go to your monitor tab. Now you can type in the symbol of that position or just, you know, if that's the only trade you took on the same day, you'll see it right here. Go up here, click on this, export file. Okay, wherever you want to save this, I'll save it to my desktop and then test file and then save it. So now you exported that CSV and now let's go over to your trade journal and you're going to go to add trade. Obviously add to this portfolio, my trades. You're on Thinkorswim. You're going to upload that file, open, and there you go. So that is automatically going to import. Now you're going to have your net P&L and we can just have all the data that we are going to need besides the average winner and the average loser in percentage that we're going to have to go back and manually just track. So if we go to trade log, you have to go click on the trade, go to playbook, select your playbook, say there's the ATH bounce. And now if you go to playbook, you'll see your ATL bounce, sorry. Now under your playbook, you can see your ATL bounce. You've got one trade and a total win rate of 0%. That's how you're going to do this. Moving forward, we're going to touch base in like 2 weeks. I'm going to let you go off on your own. You're going to come back. I'm going to look at your trade journal. We're going to end up getting obviously your win rate, overall win rate, your win rate per setup, your average winners and losers per each setup, and then overall when we combine them. And then we're going to move forward depending on that data, either into trading live capital and managing risk with my risk management algorithm, which you'll have access to, which we'll cover. And then, yeah, that's kind of the next progression. And right now, the goal for you is to go out to practice,
Get some data.
Get data, you know, just continue, rinse, repeat, and implementing everything that I've taught you over the last 2 months. And you've had like a very fast-tracked way of learning, and it's been not as easy as we thought to record, document, make sure that you guys are going along at the same pace. You're able to follow along with Josh. I've thrown a lot at you, and you really need to just now sit back,
Use what I've learned.
use what you've learned,
Put it into
and
play.
put it into play, and we'll see, you know, what your data looks like, and we'll go from there. Does that make sense?
Makes sense.
All
I'm
right.
excited. Finally get to start
Trading.
doing some stuff.
You do. All right. Awesome. Well, again, if you guys are interested in my mentorship group, the first link will be in the description below. You can head over to my website and see everything that is included and apply if you'd like to do so. With that said, subscribe for more. Stay tuned to see how Josh ends up doing after 2 weeks of paper trading, and we'll see you guys in the next one. Later. Now, I hope you guys enjoyed this 4-hour series where I took you from knowing absolutely nothing about trading to now at the point having been equipped with everything you need to find consistent profitability within the market. Now, if you are interested in continuing to develop yourself as a trader, in continuing to learn more, as the market is ever changing and as traders we have to adapt, and this video will probably more than likely soon become outdated. If you want to stay up to date on everything that I'm doing to continue finding that consistent profitability year over year in the stock market, and if you would like access to both see and copy my exact trades in the stock market from my entries to exits, then all you have to do is click the link in the description below, head over to my website. You can see everything that is included in my mentorship group and go ahead and apply if you'd like to work with myself, continue learning from myself, and have access to make money alongside myself. Hope you guys did enjoy. And I hope I provided value. If I did, don't forget to drop a comment below, smash that like button, share this video with your friends, subscribe, and stay tuned for more content coming soon.